business's most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
On the call talked about going from fix to build, and I think that's kind of the headline. He stabilized the business and is now focused on reinvesting in the parks and in the studio, which has probably been neglected for the last few years. There's going to be consolidation in media for sure, especially amongst the streaming names. Don't know when that happens. It's probably over the next few years.
Good to catch up with Chris Morangi there, the co-chief investment officer over at Gabelli Funds. Check out shares of Disney this morning, up in the pre-market following earnings yesterday. The theme park business absolutely booming. The numbers growing 31%. The pressure's elsewhere, and we can talk about the pressure elsewhere in just a moment, which is why Bob Iger is cutting costs. Committed to cutting more than $5.5 billion already going into the print, and announcing an additional, looking for another $2 billion in savings, helping the name this morning, up 4%.
Where is that $2 billion going to come from? Because you pointed out it doesn't include additional job cuts. So I have to wonder, what else is going to be sort of sold or chopped off? When you look at the 4 pillars, they did not include linear television in any way, shape, or form, or television shows. I start to wonder what's going to happen with some of those legacy platforms.
He's almost encouraged the conversation around ABC
exactly.
and ESPN earlier this year, Tom. Open the door to a sale of some of those units.
To sell to who? Help me. Who are they going to sell ABC to?
ABC, I don't know. Dan Ives of Wedbush offered up Apple buying ESPN once again.
Or a minority interest. I get the minority interest thing.
But you're right to point out the environment now for media is very different to the one we were in 2-3 years ago. Selling those units now, those divisions, Tom, that little bit more harder for Bob Iger.
You guys live this far more than I do. I mean, what are you watching at home? What of those
Bloomberg
silly
surveillance.
icons? Bloomberg surveillance, right answer.
Reruns.
But it's just great, and the forward view is stunning. When you look at the icons that are out there, which ones do you click on?
Well, the kids click on Netflix, and I'm the person who just looks for specific movies and tries to pick out which particular streaming network has.
Besides Formula One,
Peacock for Premier League football, Paramount for the Champions League, and for Serie A.
So what are you spending
Italian
per
football,
month?
ESPN, because it carries Formula One as a part of Hulu. What are we spending a month right now on apps?
Have you ever added it up? It must be nuts.
$80
well,
a month.
Hulu's close to like $90 a month now, once you have everything sort of baked in. But that includes Disney, and that includes the likes of ESPN as well. If you throw it all together, it must be pushing $150 a month. Easy.
Yeah.
That's before you're paying for broadband. We've said this a million times. Once you add it all up again, the cable bundle's back. You're not saving any money, Tom. You're not saving money at all. In fact, I'd say for the consumer at the moment, it's probably more expensive, not less.
Culture with Bloomberg Surveillance. Scarlet Fu consulting in on this morning. What you need to know is it's April of 2011. There was a show then, Game of Thrones. Winter is Coming was the first episode. And that's where we are right now with the screaming success in days of Blue Eye Samurai on Netflix. I'm watching it. I can't say enough about the shocking beauty of it. It is overwhelming how it is game-changing for streaming. Geetha Raghunathan knows this. She's U.S. media analyst at Bloomberg Intelligence, and I would suggest Disney knows this as well. Geetha, boy, does Disney need a Blue Eye Samurai.
They certainly do, and that's one thing, Tom, that Bob Iger really emphasized yesterday. He said he is looking to reinvent the studio. Those are the words he used, and he really emphasized quality over quantity. So you spoke about how spectacular Blue-Eyed Samurai is. That's exactly what Disney is going to go after. They talked about, the studio having some kind of franchise fatigue, too many TV series created for the streaming service. So they're really kind of streaming down or cutting down, I would say, paring down on a lot of the content costs. Lisa was talking about where those savings are going to come from. A lot of that is them just really cutting down on content costs. So they took down content costs from $30 billion to $27 billion for fiscal 2023. They're taking that down further to 25 billion, and that is where you get that big free cash flow number for them as well. $8 billion is what they're projecting for 2024, a 60% increase from this year.
Now, I get it, it's anime, it's animation, but the basic idea is Blue-Eyed Samurai is as non-diversity as we could get in 2023. Is Disney moving on from the tone and temperament of the last 3 or 4 years? Is Iger going back to something or new to something different?
I think it's a combination of everything, Tom, because he needs to go back to the drawing board. He knows that there hasn't really been a new Star Wars or a Lucasfilm movie since 2019. Obviously, the Marvels is in its next kind of iteration, if you will. So there's a lot of things that he needs to do. But the biggest thing I think for them, for the Disney studio, and this has kind of been a little bit shocking. And you bring up animation, and that's a really good point, because a lot of their recent animated movies have actually not performed as well as some of us would have expected, and Pixar has kind of been has had kind of this string of misfires, if you will, and the studio that is really kind of giving them a run for the money is Universal with Illumination. We had you have Super Mario, you had Minions, all of these animated movies from Universal doing really well. So Disney obviously going back to the drawing board and kind of doing a lot of rethinking and as Bob Iger said, reinventing the whole franchise.
If Bob Iger was the movie, is this Nightmare the sequel?
That's a great.
It's not going well, Geetha, is it?
Well, I mean, he tried his best, and if there is any person for the job, any person who can actually fix and rebuild Disney, I think it definitely is Bob Iger, and he kind of delivered signature Bob Iger kind of news yesterday. Lots of good news, lots of nuggets of good optimistic news for investors to kind of hang on to. Obviously, there is a lot of work that remains to be done, but we do know that there are some real growth drivers for Disney, whether it's the parks business, that is 70% of Disney's operating income, throwing out about $10 billion in operating profits and cash flow. So that definitely is a huge growth pillar for the company. And then, of course, is streaming and how they're kind of going to manage that whole business. We know that they're in the process of consolidating Hulu. The big question is how they're going to manage the ESPN transition and, whether that Disney bundle, the streaming bundle, really becomes the competitor, a true competitor to Netflix.
Is rebuilding a euphemism for shutting it down in terms of streamlining certain businesses and getting off selling the rest of it?
Yeah, so he seemed to actually walk back a little bit of, the linear TV commentary. I know we've talked a lot about ABC and some of the other networks kind of being up for sale. But he also did say that there is a huge cost opportunity when it comes to, those linear networks. And so they've actually, the Charter deal that they recently inked was kind of a catalyst for them shutting down a lot of, the smaller networks that they don't consider core. And I think that's what they're going to do. They are definitely going to streamline the business. You're absolutely right, Lisa. I'm not sure when or how the sale is necessarily going to happen, but Iger seemed to suggest that even if a sale doesn't happen right away, there are a lot of synergies and there are a lot of cost efficiencies that they can hopefully extract over the next few months.
Geetha, this one's a tough one to answer, but explore the question with us if you can. Tom mentioned who's buying. If they're selling, who's buying? Where do the buyers come from?
So it could be private equity. I mean, we know there has been interest from certain parties. Byron Allen was one who kind of made a bid for the ABC and some of the networks. Again, private equity always is interested in, the TV assets because they do. Yes, it is an industry that is in secular decline, but at the end of the day, it does throw out a lot of cash, and that is valuable. So yeah, again, it's a little bit of a wait and watch. I mean, there has been some chatter about whether the leagues would be interested in kind of going and getting a broadcast asset. I mean, broadcast assets like ABC don't come up for sale very often. So, maybe it is something that the league can potentially consider for reach.
Interesting. Geetha, appreciate the update. You're valuable. We appreciate your time. Geetha Raghunathan there of Bloomberg Intelligence. We'll catch up with Geetha again around the opening bell a little bit later this morning. Shares of Disney in a pre-market up there by a little more than 4%. What are we watching now then, Tom? What's it called?
Blue-Eyed Samurai.
Blue-Eyed Samurai.
It's great. I just
Okay.
learned this. You know, we're doing while Bram was going on. I'm looking at research of that, trying to figure out what the kids' summer camp looks like. And in the lead character's voice, Kenneth Branagh is in this. Is the voice? Kenneth Branagh is the bad guy.
Very cool.
And the lead, and I don't know her, Maya Erskine is Peter Erskine's daughter, the great jazz drummer of America. And it's just. I really can't say enough about this. It's really violent, first of all. Let me make this clear. As I mentioned to Geetha, and the whole question of the aura of diversity, this is as anti-modern woke as you can get. The only reason they can pull this off is animation.
Well, which raises this question, who's going to be animating it? And that's the reason why I thought Jeff Katzenberg's comment overnight was really interesting.
Huge respect.
Talking about how it's going to be, by a magnitude of 10, cheaper to animate things with artificial intelligence. Right. I wonder if the timing of the actors' strike ending around now has anything to do with this.
I got an email from a fan today from northeastern England, Julie from York. And Julie said to me, "What is it?" And I said, "You got to sell emotion." And that's a difference between Netflix and Disney. Netflix is selling emotion.
You've got to get rid of that woke.
It's good. It's good. See ya.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time, join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
The stock market rallied because the bond market rallied, and that's just not typical.
Growth keeps surprising on the upside, and that might continue.
Markets are a little bit more volatile right now than the underlying economy is.
It's going to be slower, but I don't think we're about to go into global recession.
It always looks like a soft landing just before a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The longest winning streak in 2 years on the S&P 500 could well be longer after today. From New York City this morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market this morning just about positive by almost 0.1% on the S&P. 8 days of gains could become day 9. We make it day 9 on the S&P 500. That's the longest daily winning streak, TK, back to 2004.
It is. We had Chris Maranghi in the last hour. We're going to start strong with Julian Emanuel, and this is about the shock, not so much of shorts. Yeah, the shorts are wrong, and I get that. Maybe they'll have their day here. But it's about people, millions of people, John, who are tentative about equities. They're just collegially afraid to be there in the confidence of price to move up right now. That's something they've got to reassess. And you mentioned the Goldman Sachs note.
Sure.
Even there, everybody's reassessing this morning.
Let's go through the Goldman Sachs note, the outlook for 2024 from Jan Hatzius and the team. The hard part is over, apparently. Lisa, it gets easier from here. More disinflation in store over the next year. As for recession risk, listen to this line. We see only limited recession risk going into 2024. A very constructive outlook from the team at Goldman.
The warm embrace of the soft landing, you could just feel it right now.
The warm hug of Jan Hatzius.
The warm hug of Jan Hatzius. The warm hug of the optimism that's coming into the equity markets. The warm hug of Tom Keene's hand as he goes down like this every time I speak. There is a question here about whether it is nice until it's not, right? And whether we're ignoring some of the tea leaves.
Ramos like this.
This is my Jane Fonda Atlanta Braves. Okay. Georgieva's like...
Anyway, are we really there, or is this something that's the beginning to something?
I don't think it's a soft landing because you have disinflation. Ed Hyman nailed this at Evercore ISI by saying we are going to get a disinflationary tendency, and yet Ed Yardeni would say, okay, and then you get a muddling along economy. I'm not sure for a lot of Americans it's a soft landing. It's price decline, less nominal GDP, and they don't own 10,000 shares of name the stock.
Let's not complicate things. It's an equity rally inspired by a monster bond market move in reverse.
Yes.
50 basis points from peak to trough in the last couple of weeks. We broke 450 yesterday on a 10-year. And you'll get the people who push back and they'll say the following. It sounds something like this. This will sound familiar. It'll look like a soft landing until it doesn't. And it's the same in the bond market, Tom. At some point, yields go low enough that you start to say, oh, what's happening with growth? Same thing with crude. You start to break 80, you get deeper into the 70s, lower into the 70s, you start to say, oh, what's happening with growth? And I wonder whether that's whether we start to see that inflection point where we break down that correlation between bonds and equities. Instead of rallying together, they rally in different ways.
I'm loving the triple leveraged all cash bond portfolio. You know that's the Austrian 100-year piece. And I'm up 18% in that puppy right now. That doesn't note that I was down 70% from when we loaded the boat.
That's a small detail.
Small detail. We're up 17%.
Nice bounce there. Nice bounce. Picking up some duration, TK.
Yeah,
sure.
Great.
Equities right now on the S&P, just about positive by 0.1%. If you are just joining us, some data, some auctions, a little bit of Fed speak. Enough to keep you watching this morning, no doubt. Yields up by 3 basis points, a 10-year, 452.74. Bramo, take it away. Give us the day ahead.
I'm just going to give you the excitement. We've got a little bit of data. We've got economic data. Hold on. Just wait for that excitement. 8:30 a.m., we get initial jobless claims. It actually is the first meaningful data that we've gotten all week because it's been such a quiet week. What I think is interesting, we always show the unemployment rate on this chart that's completely distorted by the pandemic. And so you lose sight of what's happened over the past 6 months. And what's happened is a slow creep up by a 0.5 percentage point in the unemployment rate. This is one to watch to see whether the soft landing is premature. 1 p.m. This one's for you, Tom. U.S. Treasury is selling $24 billion of 30-year notes. If it tracks what we saw yesterday, if it doesn't fail, it will be a roaring success. It could fuel another leg of a rally.
What's the distinction? You know, I bust her chops, folks. Bramo's like the adult in the room on this. What's the distinction between a 10-year enthusiasm and the 30-year enthusiasm?
There has been more tepid demand for 30-year notes, right? Both of them have been messy over the past
foreigners and domestic.
Foreign and domestic, but there is perhaps a little more concern over the longer term, especially with the fiscal. We shall see. There was actually a report saying Japanese investors actually piling into U.S. bonds. So we'll see where the demand comes from. 2 p.m., Fed Chair Jay Powell also planning to speak at an IMF panel that includes Geeta Gopinath of the IMF, Harvard's Ken Rogoff, who is the only person that Tom will be listening for, the Bank of Israel governor, and it will be moderated by
offend
the
Dr.
IMF's
Gopinath like
chief economist.
Okay,
I'll
I
leave
look
it
forward
there.
to that. Isn't it bizarre that we think the 30-year auction will go better with a yield of 4.66 than it would with a yield of 5%? Does that make sense to you?
You know, the only thing that makes sense is the number of people who came on the show who were bullish on bonds, who were not buying because they were concerned about the incredible volatility and the lack of understanding of what was behind it. Maybe they will come back when there's stability, even if it's at a lower yield.
Do they got that understanding now?
I don't know. That's
know.
a great question. Let's get Bob Michael on the phone.
Julian Emmanuel joins us around the table, Chief Equity Strategist over at Evercore our side. Julian, good morning to you.
Good morning.
Have you been participating in this wonderful, beautiful thing that is an 8-day winning streak?
Yeah, we have. You know, several weeks ago, we just felt that when you backed off of that 5% yield, and I know we've been talking about it, but it is the fact that in this world now, for the last year and a half, where stocks and bonds have been positive correlated, if bond yields go down, stocks go up. And backing off of 5% was huge for the psychology. And now we've got this unexpected oil price plunge, which is even bigger for shareholders.
I'm with you. Those 2 points yesterday stood out for me. Break of 450 on a 10-year, break of 80 on Brent crude. At what point do these correlations start to break the other way? What brings about that change?
Well, we are watching that very closely, and guess what? The high-frequency data is really important because that chart you were talking about a few moments ago with the unemployment rate rising from 3.4 to 3.9, in the past, when that starts to happen, it tends to snowball. But where we're going to get the initial read on that is that 830 jobless claims number. Starts edging over 250,000. We get a little bit cautious. 300,000 is where we know the economy is going to turn down.
I'm supposed to fold in now a question on Ed Hyman's Hicksian ISLM theory and his disinflation theory into your stock babble. Forget about it. I love the single sentence you have, which pushes against all that malarkey by saying price is paramount right now. When you talk to Ed Hyman, how does it respond to you telling them your economics doesn't matter, price is paramount?
I'll tell you how. 5 weeks ago, Ed Hyman started putting out in almost daily the fact that gasoline prices started falling. As the conflict was erupting, you already had the turn in gasoline prices completely, devoid of real sort of sense.
How can we have prosperity with Hyman's disinflationary tendency or outright deflation in China?
Look, if you look at the last 15 years, you've had episodic times of that from, again, obviously, the financial crisis was one of those times. But ultimately, what it comes back to, again, for equity investors, for bond investors, first of all, the whole idea of getting a real return on money in this world now is actually a positive for financial assets. It's a positive for capital allocation. And long-term, it's a positive for growth. And that's, that's part of the equity investing mindset.
Do you need a long-term view right now, or do you just trade the short term?
It's really difficult to have a long-term view because of what we're talking about, the inflection in the economy potentially happening. But if you take the super long-term view, is that even if you get the recession that Ed's thinking we're going to get, that it's going to be mild in 2024, what you're left with is a labor market that has rebalanced. What you're left with is, again, a real cost of money, better capital allocation, and frankly, we've talked about this before, you have new technological developments like generative AI that is going to improve the productivity of corporate America over the long term.
One of the main frustrations of this year was that pretty much everything everyone said at the beginning of the year has proven to be wrong, including that this would be the year that tech stocks would fade more meaningfully, and you'd start to see a broadening out in the rally. Energy stocks would start to be the true leaders. You just actually moved away from an overweight in energy and are talking more about generative AI. It seems like the theme just keeps on being that the leaders will keep leading and everything else will just have to figure out where they fit in.
Well, look, again, The recession will probably, to the extent that it does arrive in the next 12 months or so, rationalize some of this. But ultimately, what it's going to do, and look, part of the consternation on equity investors' minds is the fact that the Russell 2000 is making new lows. Ultimately, you're going to get to a point where there will be an attractive price for the other 493 stocks away from the Magnificent Seven, and you will get to an earnings reset. We think that's part of next year's narrative.
This is the difficult question I think people have got to confront at the moment. Do I want to buy the recovery to the recession I've not had yet? Given the damage we've seen in the small caps, you can pick up various places that back up the consumer discretionary story, airlines, for instance, which have come way off the peak back in the summer. Do I want to start picking up the pieces going into what could be a slowdown next year?
We think you need to be balanced. It's one of those things where, again, given the lack of visibility into next year, what we always say, we've had a very nice run in recent weeks. And if you go back over the last year, it's been a very nice run off the October lows. You need to be comfortable with the fact that if the market comes in 10 or 15%, which it does in any typical year, as it did several weeks ago, that you're a buyer of the dips. And whatever that asset allocation is to you, that's the kind of discipline you need to employ.
Goldman speak to this as well. We've gone through their note this morning a few times. It's worth doing it again. The hard part's over. More disinflation is in store over the next year. On growth, they see limited risk of a recession. And they say this on central bank policy. I think this is a really, really interesting point. An increased willingness of central banks to deliver insurance cuts if growth slows. Earlier this week, Ben Lader on this program of eToro was saying the Fed put was back. Lisa and I looked at each other and almost spat out our water. The Fed put is back. Insurance cuts if growth slows. Is the old Fed story returning?
No.
Why are they wrong?
No. Look, because there's an assumption that there's a reflex reaction to a minus, GDP quarter. Thankfully, we didn't see it in 2022 when we had that, because if you had interrupted the rate hiking program, you wouldn't have gotten to where you are. And you can argue both sides of this case. But frankly, for us, there is a commitment, given the fact that core PCE is still solidly with a 3 handle, that you just can't go down that road unless it really looks like there's a severe economic downturn. And we still think there's enough savings left over, so that won't be the case.
Julian, awesome as always. Julian Emanuel of Evercore. If you are just joining us, welcome to the program. Your price action, the scores this morning look like this on the S&P 500. We're positive by 0.1%. Yields are a little bit higher by 3 basis points, 452.94. Coming up in the next ad, Tom, we'll continue the conversation. Cameron Dawson of New Edge Wealth.
Futures are 4,400. Stolfus can pack it up and go home for the year. I mean, some of the bulls out there, they're hitting their targets right now.
We spoke to Gabelli Funds last hour.
Yeah.
I asked him about Meta this year, Facebook up 165.73% year to date.
And I just looked at
sticking with the name, Tom, into next year.
I saw this in the zeitgeist. I'm so sorry I can't remember who to quote. 70% of stocks don't participate in a bull market. I just looked at 3M, which is a problem child from Minneapolis. This is the Minnesota Manufacturing and Mining Company. Post-it notes.
Post-it notes.
And before that, a thing called Scotch Tape.
Yeah.
Opened me first. And the answer is 3M's done nothing. It's up 6% off the bottom, where some of these other companies I mentioned at the top of the show, Microdog is up 17% off the bottom.
You were looking at Kimberly-Clark as well, weren't you?
Kimberly-Clark, I'm looking at another
toilet paper.
I don't know what to do with it with single digit. I mean, help us here, Julian, quick. Single digit revenue growth. I'm popping 12, 15, 18% EBITDA, and nobody cares. Nobody wants these kind of stocks.
The market will embrace that in 2024.
They're going to see a deepening rotation.
Yes.
See that?
It's beautiful.
It's just such
just
a poetry.
Short. He knows there's a commercial break. Julian, thank you. It's good to see you. Greg Valliere, AGF Investments on politics coming up next. From New York City, equity's doing better than okay over the last week. We're positive this morning. From New York, good morning.
markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
City. From London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
I can talk about President Trump. I can tell you that I think he was the right president at the right time. I don't think he's the right president now.
Donald Trump's a lot different guy than he was in 2016. He owes it to you to be on this stage and explain why he should get another chance.
I think there's something deeper going on in the Republican Party here, and I am upset about what happened last night. We've become a party of losers at the end of the day. It was a cancer in the Republican establishment.
I'll say this about Donald Trump. Anybody who's going to be spending the next year and a half of their life focusing on keeping themselves out of jail and courtrooms cannot lead this party or this country, and it needs to be said plainly.
GOP presidential candidates offering a few opinions on President Trump and a state of the Republican Party last night on NBC's presidential debates. From New York City, your price action this morning looks like this: extending gains on the S&P 500, the longest streak of gains going back 2 years on the S&P, 8 days of gains. 8-day winning streak on the S&P, make it day 9 on the NASDAQ at a close yesterday. This Thursday, equities higher by 0.1% on the S&P. Yields up as well by 4 basis points, 453 after closing below 450 on a 10-year in yesterday's session. For crude, 75.70 on WTI. For Brent, 79.98. Brent crude, Bramo, a break of 80 this morning.
And the why, I think, is important. Is this because of softer demand? Does this indicate a cooling in the global economy? Or is this something else, the speculation that the Saudi energy minister was talking about? You pushed back a little bit, saying that, well, they are cutting prices to Europe, so there seems to be something bigger going on. If that's the case, is this does this coincide with the idea of a soft landing?
Does it, Tom? Crude lower, yields lower?
I think
both of those things, that's what people are hoping for.
That's what they're hoping for. Absolutely. There's no question about that. Is it a soft landing? I don't really want to frame that because I think a soft landing speaks to a buoyant real GDP. And when Nick Brennenbrook's given me a global GDP statistic of 2.4%, with China popping 5%, all my radar's up about the soft part of soft landing.
Peter Schiff, Academy Securities. Great conversation earlier this week. Fantastic. If you missed that, by the way, check it out. Just fantastic from Pete, as always. It's a moment, not a destination. It looks like one now, so buy it. It's essentially what he's saying. For the next 2 to 3 weeks, he thinks it's a window here, but ultimately, Tom, beyond then, no idea.
I'm going to go to the
I don't think anyone's got any idea.
The Goldman Sachs note today framing out, most of the economists of the quality of Hatsias are just trying to get out to Q1 2024. Who's framing the summer of 2024? No one. There's not a single American framing the summer of 2024.
Well, that's going to be what a lot of people on Wall Street do over the next couple of weeks, Tom. It is outlook season. It's upon us.
It's outlook season and also the political outlook as well. Joining us now to brief off the GOP debate last night, Gregory Valliere, Chief U.S. Policy Strategist at AGF Investments. Greg, I stood on the floor of the GOP convention of 2004, and it was a different Republican Party. George Bush Jr. wanted a more hopeful America. What's going to be that slogan this summer for the Republicans?
Well, I think they'll emphasize the economy. They'll state that Biden has not done a good job. Frankly, I would disagree, but I think that they'll make it more about the economy than anything else. The really intriguing issues are abortion, number one, and number two, how much more involved are we going to get in Ukraine and Israel?
What about the idea that they're losing elections, not doing as well in certain elections? It can be the mix of that we just saw. It can be from a year ago, November, et cetera. How do they start winning again?
Well, I don't think you talk like Ramaswamy. I think he talked himself off the boat last night. I don't see much of a future for him. Probably not much of a future for Tim Scott. So it's dwindling. You've really only got three challengers. DeSantis, who was okay last night, but made a strategic error. He didn't mention the governor of Iowa had endorsed him. I can't believe he didn't talk about that. And then you've got Nikki Haley, who'll stick around for a while, maybe Chris Christie, but we'll begin 2024, I think, with just two challengers to Trump. And that would be DeSantis and Haley.
Do you think either of them have a chance of taking Trump off the ticket?
That who would?
Either of them.
Oh, no, and not at all. I mean, Trump would have to do something really egregious, and he's pretty much filled the role on that for the last couple of years. So, no, I don't see anything, barring a health issue, that will keep Trump from being the nominee.
Meanwhile, President Biden is going to meet with the UAW leader today, and there's a real question of what he can do to shore up the image of Bidenomics, of what's happened in the economy, which some people are saying on paper doesn't look so bad, yet in practice has a lot of people feeling like they want something different.
Well, it's a good question, Lisa. I'm told that within the White House, Biden is angry. He feels he's done a pretty good job in the economy and gets no credit. So he's going to hit the road and try to make his case. The problem is an awful lot of Americans fear that we're not out of the woods and there's still more inflation threats, food, gasoline, still to come.
Greg, Valier 101, folks, this is a great course to take in politics. You get it off the back of a matchbook. You can take Valier 101. Greg, your Valier 101 is fiscal issues at the day of the election don't matter. Are you telling me the debt and the deficit don't matter the first Tuesday of November?
Well, when you look at net interest costs, you look at borrowing costs, this is becoming a major crisis for the bond market. And there's no mood in Congress whatsoever to dramatically cut the deficit. However, I think that once we get through Labor Day of this coming year, this stuff will be irrelevant. I think attitudes harden during the summer.
Yep.
If Trump is well ahead, he could pull this out. But I have a feeling that Biden will come back. I have a feeling that the Democrats all of a sudden are motivated because of what happened in Kentucky.
Is the path of least resistance for the former president another tax cut?
That's going to be on the agenda. You're absolutely right, Tom. And I think with the Senate probably flipping and the House probably flipping, you're going to have a climate that will be ripe for a huge argument on whether we extend the Trump tax cuts. I think we will. I think Trump will talk about tax cutting, even though the deficit is enormous.
Greg, I have to wonder whether this time is different. A lot of people who come on the show will say dysfunction in Washington, D.C. is the reason why yields have been flipping and flopping and going all over the place. And then they talk about a potential government shutdown and say markets won't care. Have we reached the point where market dysfunction is going to result from political dysfunction in D.C. in a more material way?
Well, we're going to see probably another alleged crisis on November 17th if there's no budget. I don't think the markets will be all that concerned about it. I do worry about the credit agencies, Fitch, S&P, downgrading U.S. debt, not just because of the size of our debt, but because things are so dysfunctional in getting a budget.
Great to catch up, Greg. Appreciate your input. Greg Valier of AGF Investments going into next year. My favorite stat right now, politicians and the distortion of reality between what they want to talk about and don't want to talk about. America right now is producing 13.2 million barrels of oil every day. And if you were to ask, I think, the average person on the street, Tom, and you can do this one day, go around with a camera and a microphone, go to different states and ask them what their political affiliation is.
Madison Avenue in the 60s.
Once you've asked them what their political affiliation is, ask them how much crude they think we're producing in America right now. We're producing more now than we were in the Trump years, and see what they say. And I don't think they're going to say what you think they should say, which is ultimately, we produce more now than we did then. The issue is that the Democrats don't want to talk about it either. Bramo, the White House doesn't want to talk about that stat. They don't want to talk about that data point because they don't want to upset a fringe of the party that would be upset that America is producing 13.2 million barrels of oil a day.
It's a fascinating point because on the Republican side, they don't want to talk about that because that actually feeds into this idea of, well, let's explore what the United States has to offer. Let's drill. And President Biden doesn't want to talk about that because it goes against some of the clean energy initiatives that he himself has put out there. On the Republican side, I would argue nobody really wants to talk about abortion. That's sort of the conversation over there because on one hand, they're, losing on that issue and they recognize that. On the other hand, they have to cater to certain constituencies. So at what point do you just cater to a general election rather than constituencies?
Into our coverage of the conventions and the political stream and all that, what it really comes down to is if you look at this, is it going to be an election about culture wars or is it going to be an election about economics? The economy's stupid. I'm not so sure this time around.
The conversation continues. Megan Robson of BNP Paribas. We'll find some time to talk about crude a little bit later. From New York City, this is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Keep it together, Bramo. Equities on the S&P 500, positive here. positive over the last week or so. On the S&P, we're up by 0.1% over the last week. 8-day winning streak on the S&P 500. Day 9 on the NASDAQ in yesterday's session. We're pulling back a little bit on NASDAQ futures. We're down 0.1%. The Russell looking to bounce, been really beaten up over the last few months. Off the summer highs, down about 18%, just a bounce off the low over the last couple of weeks. We're up here by 0.5%. In the bond market, 2-year, 10-year, 30-year, 10-year yield, a break of 450 in yesterday's session. Yields up this morning by 5 basis points, 454, up 7 basis points on a 30-year, 468. Bramo, some issuance coming again later this afternoon.
Yeah, we're going to be getting $24 billion of 30-year bonds. Is this the stability that people have been looking for? You asked this question earlier. Have we seen enough to show that the technicals are giving people confidence that these valuations, these levels are real? I don't know the answer. I don't know what people need to get that conviction, but I think it's the right question to be asking.
Still getting big swings in bonds. We'll talk to Mohamed El-Erian about this a little bit later. He's going to join us at 9 Eastern time on Bloomberg TV, so look out for that. Let's finish on crude. We mentioned crude production in America, 13.2 million barrels a day. No doubt helping out crude, Bramo, with crude back in the 70s, 75, 79, positive by 0.6%. Should we focus on supply or should we focus on demand?
Certainly, people have been more focused on demand over the past couple of weeks as the possible reason for the declines. I don't know whether that's the right place to look. This is one of the most confusing signals to get. A lot of people are saying that maybe this signals a bit of the soft landing because at least the demand is cooling but not dropping off a cliff. We shall see. This is actually one of the most important places to watch.
Those 2 points, TK, Brent breaking 80 in the last 24 hours briefly. The 10-year breaking 450 briefly. Those 2 points stand out across the screen for me this morning and yesterday.
I take it global, as we talked about all morning. You've got a global disinflation, outright deflation on pork in China. And where I'd really go, John, for this in terms of a global sense and how you get to these low GDP numbers is Germany. I don't think we've talked enough about the new Germany, which is not the stereotype we hold in our minds, is a manufacturing juggernaut. They've got serious disinflationary and growth tendencies.
They've got to see some real changes there. They need a new growth model.
I mean, we've underplayed it, and I just think that's off the mark a little bit. Again, look at the bid on the screen here. I got Russell, what is it, 2,000, 5,000? I can't keep track, up 0.5%.
The small caps are up this morning, Tom. The S&P's high too. That's wonderful.
It's a data check.
Russell 2000 futures, TK. It's written on the screen there, up by 0.5%.
It is written.
Under surveillance this morning. Israel's military saying it killed the head of a key Hamas missile unit in a targeted airstrike. About 50,000 Palestinians have fled to southern Gaza, according to Israel, as the army pushes deeper into Hamas strongholds. This as U.S. warplanes strike a facility in Syria used by Iran. Defense Secretary Lloyd Austin saying it was in retaliation, Lisa, to attacks on American forces in the area.
I was struck last night at the Republican debate at the tone about Iran. They really went directly after Iran, all of the Republican candidates. And regardless of the criticism that President Biden has come under for the approach for the U.S. government, the Republicans, the vision that they offered was even more so on the other side. So that seemed to be the poles of where this is evolving.
I wonder where that is 6 months from now, 8 months from now, with Iran. Whatever happens within this terrible war in the Eastern Mediterranean, I just really, really wonder how we fit into a new diplomacy with Iran. That's under huge debate among people in international relations.
These things, Tom, that you can say when you're out of power and not in power.
Exactly. Yeah, that's huge.
If you take Nikki Haley off the debate stage, what does Nikki Haley stand like in the White House?
Secretary of State
confronting
Haley,
this situation?
or,
Precisely.
Yeah.
I don't know the answer to that, but you'd have to imagine that maybe they temper some of the message. What are you up to?
The surveillance fly is flying around the studio.
It's been doing that. That fly's been going around for the last 2 weeks.
Yeah, it's got a bow tie.
Let's get to the next story. The fly's got a bow tie?
Yeah.
Okay. Hollywood studios and actors ending their strike, tentatively agreeing to a new contract. The union saying it negotiated a contract of over $1 billion that includes unprecedented restrictions on the use of AI to recreate an actor's likeness. I love this. We're going to have to do this, guys. The SAG-AFTRA's National Board will review the deal tomorrow. Is that the future, Bramo? We're going to have to tell our bosses no AI impersonations of anything we do.
Or at least we need to get royalties from those AI impersonations.
There we go.
So, you know,
just sit at home and type the script.
Exactly, and they can speak it for us. To me, I wonder how much they came to a deal after 118 days because of the pressures that they're seeing with the cost cuts, the likes of Disney. They're going to be talking about how to streamline some of the production costs. Well, you know, if they're going to get a piece of it before AI just takes over outright, they might as well get it now.
The damage is done, isn't it, Tom? The movie slate has been pushed out 2,
Yeah, that
3,
always
4,
happens.
5 years.
Yeah, I'll go with that. But my answer here is the customer is going to decide. It's the customer that decided they wanted to watch Game of Thrones, they want to watch Netflix. Clearly, the customers decided they want to watch YouTube. Where does the actors and actresses come into YouTube participation? I don't get it. You know, I just don't, I'm not sure I know where the future is. I'm certain this morning at Warner Brothers Discovery, they don't know where the future is either.
You're long Netflix this morning, right?
I'm way long Netflix, yeah.
Blue-Eyed Samurai.
Blue-Eyed Samurai is the new Game of Thrones.
I'll
It is
check that out.
Jaw-dropping.
Okay, I'll check that out.
It is gorgeous.
This weekend. Let's finish on these comments. Citadel founder Ken Griffin warning that the higher baseline inflation may last for decades. Griffin sitting down with Bloomberg's Eric Schatzker at the Bloomberg New Economy Forum.
There's many trends at play right now that are pushing us towards deglobalization. And with that is almost certainly a trend towards higher baseline inflation.
Over what period?
It could be for decades.
It could be for decades. Tom, that is going against the grain this morning, for sure. Because after you get a 50 basis point move on treasuries, all of a sudden the narrative flips. Narrative flips, Bram, almost instantly.
You can't even do this with a straight
We're going
face.
back to the pre-pandemic world, low and stable inflation.
2%.
Jay Poloski, TPW, was really going in that direction yesterday. Yeah, Ben Laidler earlier this week. TK, are we going back to that, or is Ken Griffin going to be right?
Ken, you know, I don't know. I got Ken Rogoff. Speaking of another Ken Rogoff's going to speak today.
So excited about Ken Rogoff.
And I'm going to listen to Ken Rogoff about inflationary dynamics
I
here.
like Ken Rogoff too, but I've never seen someone so excited about
well, I'm excited
Rogoff
about it in terms of macroeconomics. What I want to talk to Ken Griffith about is the incredible concentration of the market in what he invented, which is this minuscule, hugely profitable trading method that they use in the modern day. I mean, Ken Griffith's not making eights off Anaconda Copper.
So you want a conversation with Ken about Citadel the machine?
I don't think people know what Ken invented. I don't think he's gotten credit for
his
it.
thoughts on macro. Or
You
want
know,
both?
I'd like his thoughts. I'd like both.
A bit of
Yeah, I
both,
think he's
okay.
got him some slack. I'd like both. But I find it absolutely stunning. This, as we heard from Julian Emanuel, the market we are in is original, and I certainly do. I'd love to know what Ken thinks about
This rally's original over the last couple of years. 8-day winning streak on the S&P, Tom, could become day 9 a little bit later.
Day 9 for commercial real estate is it's here. That's all you need to know. Cranes has done a great job of this in New York, and the victim du jour is a lovely old building in Brooklyn on J Street, which I was reading about this morning. Megan Robson knows this cold, the head of U.S. credit strategy at BNP Paribas. Megan, thanks so much for joining. Commercial real estate, the default rates, I'm going to just cut to the chase. From where I sit as an amateur reading, it's grim. Is it grim?
We would agree commercial real estate is going to be one of the more rate-sensitive parts of the market, and we will see defaults rise there relative to other sectors. I think looking at defaults and delinquencies already across the board, corporates and consumers, the areas where we're seeing problems so far have been in these most rate-sensitive areas, commercial real estate, where we see risks building and growing, leveraged loans, another place, floating rate interest payments have seen defaults rise to 5% recently. And then also on the consumer side, recently with the Fed's data that we got this week, you saw revolving credit delinquencies for credit cards creep a little bit higher. So commercial real estate, definitely a well-flagged area for weakness.
We've been talking for a past couple of days. What kind of stability do people need to see in benchmark rates to gain confidence to come up with business plans, for corporate issuers to come back to the market? And we've already seen corporate issuers seize this opportunity and flood back in. Is this enough? Are these rates just fine as long as they stay here and there's some sense of stability for all of the investment-grade issuers?
To your point, Lisa, we've seen a lot of issuance this week. So for some context, yields relative to the recent peak in investment grade, 45 basis points lower, in high yield, 50 basis points lower for some of the higher quality issuers. And we've seen corporate treasurers take advantage of that and pull forward some issuance this week. Going forward, though, we do expect very muted net new issuance. So we think the incentives are very much in place for deleveraging, looking at things like M&A volumes, earnings growth, the cost of debt versus equity. All of those all of those factors would support for less issuance next year. In investment grade, we're actually forecasting net new issuance to be 18% lower in 2024.
Given lower issuance, given deleveraging, there's a real question that Peter Scheer was raising yesterday, which is that maybe corporations won't have to pay a premium over government debt rates, given that they're being more fiscally responsible than the U.S. government, and that you could see spreads come very, very narrow. Do you agree with that?
I think for now, we actually do not agree with that. So we have fundamentals deteriorating. We still believe that corporates should have a premium over the risk-free rate. If you look at earnings, top line growth of revenue, we've started to see some weakness there. And going forward, that will mean you have leverage creep up. And you also have, of course, a main challenge next year of interest coverage as issuers start to face the maturity wall that is going to weigh on their balance sheets.
Window the maturity wall. That's right where I wanted to go. The idea of, like, I get commercial real estate's 5 to 7 years and you've got to refinance and all that. But in your world, what's your timeline out? Are you looking out 3 years OMG, 5 years OMG? Is it out farther than that?
So we expect that most corporates, higher quality, will be about 12 months forward-looking, and then lower quality issuers will have to refi about 18 months in advance. So next year, we think that in 2024, it will be a challenge for lower quality credit. So triple Cs, for example, will see interest coverage fall to the 10th percentile, according to our forecast, if they refinance at current yields. Heading into 2025, you see an even bigger pickup in the maturity wall. So if we are here at high for longer,
the maturity wall.
It's out there in the distance. It's like Game of Thrones, Tom. Really dangerous. You don't want to approach that. You want to act before you get there.
Coming to a theater.
Yeah, especially if the Fed doesn't
Labor
cut.
Day.
All of that bad stuff. Can we just finish on the primary market activity this week? Ignore us. Don't worry. I got some messages yesterday that said things have been really hot. Demand's been great. Can you give us a little insight into how things have gone this week?
Yeah, so I think the issuance has been received very well. We were thinking around 35 billion in IG. We've seen well in excess of 46 billion issued so far. New issue concessions have been extremely low, and deals have been well received. I think it speaks to kind of the technical picture improving a bit with the rally in yield. So we had outflows from credit with the sell-off in rates, and now with some stability, demand coming back, and that's really been able to support some of the new issuance.
It's amazing how the trend supports things. I just can't, it's really instructive. It's kind of like 5% on a 30 years a problem, 466 brings back demand because people are enticed by the move and the directional move in yields and not the levels. Isn't that kind of bizarre? Same thing in credit. You start to see the rally emerge and people want to buy it.
People want to buy it, and people want to issue. They want to take this window because it looks like a window, even though 460 is, 460 percentage points above the risk-free rate 2 years ago. So at what point are we looking at narrative roulette that burns a whole host of people?
Megan, good to see you.
Thank you so much for having me.
Thank you so much. Megan Robson there of BNP Paribas. If you're just joining us, talking a lot of fixed income, equities look like this on the S&P 500, positive here by 0.1%. In fixed income, yields are higher by 5 basis points, 454. But to Megan's point here, Lisa, primary market activity really starting to build up in credit this week. Great demand, taken down pretty well. Seeing a similar story develop in the Treasury market so far, at least, so far this week.
We have seen buyers line up, and the question really is this sustainable, and is this with the backdrop of companies, yes, bringing forward issuance, as Megan was saying, but not planning to sell all that much later, right? This is basically the chance that people have to lock in this kind of duration, like Tom with his Austria bond, for a prolonged period of time at yields that are the best.
So do you anticipate, with your skill in this, do you anticipate another mega deal from these high-tech flyers?
I don't know.
You're so excited about Apple coming to market.
No, I don't mean Apple could be any of them.
Coming up
I don't mean
day.
Does Berkshire Hathaway take bonds? I don't know. I just
50 basis point move on yields, and it's like everyone get back here.
I know.
It's amazing how sentiment shifted. Stephanie Roth of Wolf Research reacted to jobless claims in the next hour. Jobless claims about 45 minutes away.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we presented with a plan.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
In terms of big tech, I think the strong get stronger. What I see out in the world is a much different environment in terms of the growth that's happening. And I believe tech, to your point, you're going to see the strong continuing to dominate. And I think in terms of AI, we are just in the early stages of monetization. I think that's a big thing in this tech bull market.
Drum roll, breaking news. Dan Ives of Wedbush, he is still bullish on tech going into year end. And why not after the week we've just had on tech? The NASDAQ 100 with a big week of gains. 9 days of it now on the NASDAQ. Equities right now shaping up as follows on the S&P 500. Can we deliver another day of gains? The equity market positive by 0.1%. This equity market rally inspired by this monster bond market move with 50 basis points lower than the highs of a couple of weeks ago. At the close yesterday, Tom, a break of 450. This morning high by 5 basis points, but way off the highs of 5+% a few weeks ago.
I get the yield linkage here, and there's some other oddities going on. We haven't even talked about UA speaking in Japan. I got a 162 euro yen. But it's sort of like a big sigh of relief that things are unfolding and some of the mysteries are being cleared up. And so you say, okay, but maybe equities are moving on their own accord and not just because of bonds.
Have the mysteries been cleared up? Or have we just seen a big move in the bond market that people have taken comfort from?
That's the speculation.
And we'll get to see more data a little bit later. Jobless claims coming at 8:30. And I would point to a line. I keep reading Renaissance Macro, Citi. I see this in research everywhere at the moment, that the labour market is no longer a reason for this Fed to be hawkish because of the rebalancing we've seen. And the likes of Jan Hatzius over at Goldman, Tom, when they say the hard part is over, they're basically saying it's easy skiing from here to get inflation back towards 2%.
Bramo's squirming over there.
Without much pain.
I'm really just thinking about what you guys are talking about. What happened? What's changed? Is it just that no monsters have come out of the closet, right? I mean, is there basically a wall of worry that's been hanging out there?
Walls,
is the Fed different walls, right?
Walls.
That's a good question. That's a good point. There's yes, you did, the Game of Thrones wall. You've got this wall of whether or not the Fed is going to keep hiking rates. You have this wall of inflation. You have a wall of potential reacceleration in the labor market. None of that's come true. And then you had the wall of worry about Treasury issuance, and we had that sort of allayed a little bit yesterday. And is that sort of feeding this sense that maybe we can lean into this into year end?
I'm just so pleased I sit between you both. You know, just a bit of separation. Probably a good thing. You know, keep it together, TK. You've got this.
Right
Do you want
now,
to read the next intro?
I'm going to do it because we're all standing around. Those of us short in the triple leveraged all cash fund, that's really worked out the last 9 days as well. To give you a brief on things moving higher is someone who understands concept of technology, not only the finance. He is Alex Webb in London, and this is without question our tech interview of the day. Alex, it's just as simple as this. It's about fear and greed, and just to pick Apple, if you loved it at 193, you're really going to love it here. Who's buying these stocks? Who's making these ginormous market cap stocks move? Who are the buyers at the margin?
I mean, presumably it's all the people who have seen the way that even when we think there are problems with Apple, it still manages to put out numbers that are not bad. It manages to consistently beat expectations. Even as some of those expectations come down, it still throws off a huge amount of cash, which obviously in the current climate is very, very attractive. It's very hard to discount Apple. Actually, if you look at some of the multiples of which it's trading, it's traded about 28 times, I think, last time I checked. It's forward earnings. It's a bit of a premium to the market, of course, but it's not anywhere near the sort of 50 to 60 times forward multiple that we see on Amazon. It's actually very close in multiples to Disney, and that's a company that people have had hesitations about in recent months, given the way that its investment trajectory has changed.
I mean, I look at Microsoft. Okay, I guess they've won at AI. John, have they won at AI?
I don't think anyone's won per se just yet. Winning in the eyes of investors, possibly.
It's like it's an American movie, Alex. You don't know it. Butch Cassidy and the Sundance Kid, and they're looking off in the distance, and we're looking off at tech, the new tech, and we're saying, who are these guys? Who is this new tech that we have to buy shares of every single hour?
Look, we're so early in this AI race game, whatever you want to call it. We're probably even just approaching the first hurdle in horse racing terms. At the moment, AI is a cloud product. It is a way, when we think about generative AI, we think of ChatGPT, Google Bard, and the things they're based on, Lambda and GPT-4. Like, these are products that the likes of Google and Microsoft are using to sell their cloud products. If you want to be using these generative AI models, you need to be using Azure, probably in Microsoft's case, you need to be using Google Cloud. There is going to be so much more that comes in AI that is a lot more sophisticated, a lot more specialized to whatever your company's end purposes might be. That is when we start to get into the second and third and fourth hurdles, and we'll start to see new names coming out of the woodwork. And it won't necessarily just be these massive monster mega tech firms that are the beneficiaries.
It makes the smartphone business right now sound a little boring, Alex. So let's talk about the smartphone business. Arm came out with some earnings yesterday after the close. The revenue outlook, the midpoint of that outlook, a little bit lower than expectations. In some people's minds, speaking to a slowdown in the smartphone business. Talk to me about what's happening on that front for the likes of Apple. The numbers we've seen more recently, Alex, is that a reflection of increased competition, a difficult market? What is it?
I mean, look, it's a number of things. Firstly, there is some competition in China. We've seen Huawei come out with this phone that was a lot more advanced than anybody thought would be possible for a Chinese company to manufacture domestically, thinking particularly about the chipsets they've managed to develop. That's a little bit of a headwind in what has historically been one of Apple's biggest markets. We're also seeing general slowdown in purchase of smartphones. That's a lot of it to do, yes, with consumer sentiment and disposable income, but also the pace of innovation has slowed. There's not so much more that we're seeing at the moment, and what can be done with that hardware. There are some software innovations. Like AI is a software innovation, a lot of it. There are some hardware pieces to it. Increasingly, we're going to see more AI functionality brought into smartphones. There is actually quite a lot already that we're not quite fully aware of without thinking about it. The way that they sort pictures and things on your phone is often done with an AI model. Those three factors put together, the headwinds, the consumer sentiment, and the slower pace of innovation is hurting the market as a whole.
There is a feeling, Alex, that Apple is the most leveraged to the consumer cycle, to the economy, and the others are a little bit more independent. In particular, the cloud service providers like Amazon, like Microsoft. Do you think that that's going to hold true come next year? That this is essentially going to be the theme, that these are going to be havens on the way up and on the way down, even as some of the others splintered away, like Apple?
Apple, yes, it is sort of slightly yoked to consumer sentiment, but it does play in a different space than a lot of the other consumer electronics companies. There's a little bit less price sensitivity. There's some, but there's less price sensitivity among Apple consumers, and Apple has managed very effectively to build out its services business, which is higher margin and is recurring revenue that you get month after month after month. That has been a big success. Now, it isn't in that enterprise space in quite the same way that Microsoft is with its cloud business and its sort of panoply of other offerings, and that makes it perhaps a little bit more vulnerable in some senses. That might be why it's not trading at an overly generous multiple when you look at some of those other big tech names. But as ever, you can never discount Apple. They always somehow manage to pull something out of the hat.
Alex, appreciate the update from you and the team over in London. Alex Webb there on the latest on a smartphone business for big tech as well, after some stellar gains for big tech so far this year. Year to date, to see NVIDIA up by 218%. I mentioned Meta up by something like 165%. Tesla, Tom, up by 80% year to date. Off the high, sure, but still, there are some stellar gains year to date.
Away from our addiction to index funds, I'm just going to look at one of the sell-side debates here, and this is Apple, Tom Forte, D.A. Davidson, and you mentioned Mr. Ives at Wedbush as well. And that span off the Bloomberg screen is $166 out to a share price of $240, and Ives even indicated farther out he's modeling $270. There's a huge debate about what Alex Webb just spoke of.
Well, Ives is talking about this big upgrade super cycle smartphone business going to keep steaming on. I think Tom Forte's pushing back against that, Tom.
Yeah, and he's not alone. Let's be clear, Forte's not an outlier. There's a lot of people that are just saying this puppy's not going to move.
Just want to squeeze in a bit of news regarding Apple. Not sure if you saw this, Tom, but the Apple co-founder Steve Wozniak reportedly hospitalized in Mexico City. That's according to press reports. Conflicting reports as to what's behind that, Tom, but I think we all wish him the best and hope for a speedy recovery.
Yeah, it is. I mean, this guy's iconic, and it's all wrapped around the tragic early death of Steve Jobs, and he's been visible. He's been an acolyte, I think, for technology in what was years ago an absolutely unique way. He's never gotten the credit that he should have got. We all looked at that box years ago and said, are you kidding me? They're way out front.
That's the latest on tech. Coming up, Cameron Dawson and New Edge Wealth on this market. What a run we've seen in equities as we anticipate some data about 34 minutes from now. Jobless claims in America. Yields are higher by 5 basis points, 454 on a 10-year. Equities are up by 0.1%. From New York, good morning.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, Our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Slowdown is taking place here in the United States, but it's a gradual affair.
There is volatility and possibly upward pressure on rates where we sit right now.
I think that's very much indicative of what the Fed has been telling us, higher for longer.
Everything's so volatile. We don't know where this economy is turning. We don't know what's going on there.
I just don't think we've seen the impact of rates just yet. I think it's a 2024, maybe even to 2025 story.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. The stock market, a meld up, maybe not. Maybe it's a grind up. We'll see 8-9 days in a row. Green on the screen right now. Futures up 7, and we're leading. Our team is put together. This is unbelievable, John.
What do we got?
We've seen in the equity space before we go to the bond space. We had Morangi. We had Julian Emanuel, and we're going to speak to Ms. Dawson here in a moment about their enthusiasm for equities.
Well, the first 2 out of those 3 constructive. We'll see if we make it 3 out of 3, Tom. I think a lot of people constructive, given the moves we've seen so far over the last week. You said 8-day winning streak on the S&P, make it 9 on the NASDAQ. Can we lift again in today's session? TK, the outlook, already the happy talk going into 2024. Goldman Sachs, the hard part is over. Is it easy from here?
Important Goldman Sachs. No, Krispy Kreme note just out moments ago. I'll have to look at that here on the break. I need to go to the bond market because people are saying bonds better, auction better. Auction talk at 8 a.m. on Bloomberg Surveillance. Let's go to it. Ian Lingen at BMO Capital Markets channels Bramo with a very important statement here. New 30-year auctions have a very long history of tailing. I have no idea what tailing is. Leaving the only directional impulse from the event, the magnitude of said tail. While a concession is clearly awarded, the final auction of the true funding series means Bramo will shut up. There's the
Only you could turn this into comedy. Only you could turn that into comedy.
Auction comedy. Go with it, guys. Fabosi, thanks for watching. Help me here.
Okay, thanks for setting me up to really give a thrilling thesis about it. Basically, it means they typically don't perform that well. That typically the prices sag after it's sold and after the issuance price is announced. This is the question. Will this be as solid as what we got yesterday?
What are we seeing? Seriously, this is
to give people confidence.
I make jokes about it, but this is serious. Yesterday, the tail showed people have confidence in America, right?
The tail showed that there was no catastrophe. That's what it showed. That people, it was basically okay. I mean, I can't believe
this is the worst fixed income clinic that has ever aired on this program.
Can you see the head of marketing? Can you see Bramo as senior VP fixed income and the marketing guys going,
all right,
Lisa, don't
let's clean this up. Kit Juice, here's his headline this morning and his quote this morning, Bramo. Yields in the dollar have peaked, frustration levels haven't. How frustrating are the next few months going to be?
That's very well cleaned up.
Thank you. I'm trying my best.
It's really good. You did great. This is going to be maybe a sense of calm. If you get a lack of any kind of huge run-up in yields like what we saw over the past few weeks, maybe people can solidify around some sort of thesis.
I want to get to the data check, but this is important. We've had a running domestic here this morning on Bloomberg Surveillance, and this is the emotion that's out there. Can you imagine, seriously, can you imagine an equity strategy team or a bond strategy team trying to get to the end of the year outlook right now? There's some serious domestics going on Wall Street.
Good luck to them. Good luck to them going into 2024. It's difficult to get to year end. I'm just hoping Cameron Dawson doesn't walk off the studio floor in a moment. Stick with us, Cameron. Let's get through the price action. Equities on the S&P positive here by 0.2%. A lift here in the equity market, Tom. A lift for yields too. We're up by 5 or 6 basis points. No drama though. 455. A break of 450 yesterday. Crude in the 70s. 76 up by 0.9%. Brent crude yesterday, Tom, with a break of 80. So those 2 points I keep going back to. A break of 80 on Brent crude briefly, and a break of 450 on the 10-year briefly, just taking away from some of that inflationary fear over the last couple of weeks. Whether that turns into demand concern is going to be something we can talk about through the next week or so.
And we haven't mentioned this. Next week, CPI and retail sales have to be a profound confirmation of this. Perhaps, John, moments ago, pure green on the screen, the VIX is in. We're up 8 on futures, Dow 66, and the NASDAQ 100 just turned green as well.
There you go.
First time this morning.
It could be day 10 for the
Perfect
NASDAQ 100.
setup right now. Let's get to it. Cameron Dawson, as we had Marangi and Emmanuel as well. Are you a confirmed bull, Cameron?
I think that given the setup into year end, we can expect some kind of Santa Claus rally just because of tax loss dynamics into the end of the year. The largest weights in the index are up the most this year, which means that you don't have eager sellers to recognize tax gains. This is very different than last year, where the largest weights in the index were down a lot, people sold them, and you effectively puked into the end of the year.
Okay, you what?
It's the proverbial puke into the end of the year.
Oh, okay, thank you. Can we say that on radio?
We just did.
We just did. Cameron, seriously, Warner Brothers Discovery yesterday puked, as you call it, okay? How is that handled by tax loss selling?
Well, I think that it will magnify as we go into the end of the year. You look at the areas that are down the most. This is small caps. This is cyclicals. This is healthcare, some of your defensives. These are the areas where people are looking for tax loss harvesting opportunities. The key point, though, is that they're smaller weights in the index, or they're not part of the index. So when we just look at the S&P 500, that could be something that supports it into end year.
So help me here. Am I buying the index, the S&P 500, and am I looking for buying opportunities in small caps, the financial things that have struggled? What am I doing?
I think that you have to look for opportunities and things that have struggled as you go into 2024, because we know that pain trades usually are reversal trades in leadership. And just at the point where everybody throws in the towel and says, well, you can't own anything but the Magnificent Seven, these are the names that give you optionality on AI, and they have the best earnings growth. Everybody crowds into them. That's typically the moment that's when they start to lag. And so I think we have to have the imagination that other things could do well in 2024, other than just the narrow leadership that we've had this year.
Torsten Slok of Apollo is writing questions for us this morning. This is the question he's asking in his most recent note. Everyone who's bullish on equities and lower rated credit should ask themselves where they think the labor market will be in 3 months, with the Fed on hold and not showing any signs of cutting anytime soon. What's your labor market bet with that in mind?
We are having the ultimate debate is if we're seeing normalization or we're seeing weakening. And the challenge is that normalization is usually the gateway drug to weakening, meaning that you see a little easing that turns into a lot of easing, but we're not yet seeing definitive data yet to say that the uplift we've had in unemployment is going to barrel higher. The key thing to remember, though, the Fed itself in its SEP, the Summary Economic Projections, has unemployment going to 4.1% next year, and they're not forecasting a recession. So that's going to be a key question of, if we get that 4.1%, does that justify them easing policy?
Is it okay to sort of say we don't care for now? Down the line, whatever happens will happen. In the meantime, we can dance in the head of a pin with oil prices coming off, yields coming lower, and risk appetite still available.
Yeah, because if we think going into CPI next week, remember that gasoline prices are down 10% over the month of October. That's very different over the summer months where gas prices were up a lot. It pinched consumer spending maybe a little bit at the margin. So that does create this beneficial environment. But I think it's important to remember, 2022, we priced in the earnings recession in 2023. 23, we priced in the earnings recovery in 24. What are we going to price in 2024 as we look to 2025? Are we still confident that this entire economic setup can remain very strong, that unemployment won't be an issue, consumer spending can remain robust?
Given the lack of certainty around some of the outcomes, the potential outcomes with the economy, How nimble are you remaining? How are you remaining nimble to be able to adjust quickly?
I think we have to remain completely nimble. We saw that over the last couple of weeks, where we went from deeply oversold to to getting close to being overbought. It means that technicals become really important. We can't get too lodged into narratives, because narratives would have told you everything's ending back a couple of weeks ago, be scared. Now the narratives are saying everything is fantastic. The thing is that we are at resistance when we look at technical levels. 4,400, very important for the S&P 500, 4.5%, very important support for the 10-year. How we interact with those resistance and support levels will be very indicative of the next couple of months.
Speak to the people who listened to you and said, okay, I'm really nervous, but I'm going to participate in this market, and they own tech, which literally on an hourly basis has a bid right now.
Yeah.
What's the character of that bid on the Magnificent Seven?
Well, it's extraordinarily strong, but then think about the difference in the setup. Going into 2022, Magnificent Seven earnings had been cut by about 20% over the course of the year. Now going into 2023, over the course of 23, Magnificent Seven earnings had been revised higher by 60, 70% on average because of the better growth that they've had. So it's a much higher bar, and I think that's where the discipline is not trying to extrapolate too much of the experience of 23, get too crowded, and instead look for opportunities in areas that might be more left behind.
You've been talking, Cameron, about how difficult it is to follow the mood because it swings so massively from week to week. How much has the move that we've seen in yields underpinned your conviction that you can lean into the rally heading into year end?
It certainly has helped. We've seen it play out in the valuation, and now valuations are back to about 18.5 times earnings. The question is that the right valuation, even given where yields are at 4.5%, where that equity risk premium is? The challenge with valuations, though, is they are terrible timing tools, and that they have no predictive power on a one-year forward basis. So we can look at the market and say, hey, it's expensive here, expensive there, but that may not actually show up in price action for 2, 3, 4 years. And that's where that discipline of not chasing very high valuations comes in when you have a longer holding period.
You got breaking news, TK, on donuts. Is that where you want to go?
Donai, plural.
Donai?
Yeah.
What's the
Long
news?
ago and far away, the way a prime broker attracted a hedge fund
was
is
donuts.
we can get you shares of Krispy Kreme to short. There's in the East Coast particularly, and the Krispy Kreme's a more southern thing, and they're a different donai than what you get from Dunkin' Donuts, which is, there's cultures here, John. It's like Greg's, but it's like American.
Okay.
All of a sudden, Krispy Kreme, nice video on radio, you are missing the making of the magnificent. And the answer here is Krispy Kreme is looking for a partnership with McDonald's. John Tower out with this, and it's a mixed story of EBITDA out there, but John Tower at Citigroup says first bite on DNUT. It's a McDonald's partnership that we may see.
Do you know what you don't know? And I know this story already because Bramo shared it with me before. Bramo breaking into the news industry in Fargo years and years ago for the first Krispy Kreme shop. True story. True story. True story.
True story.
True story.
I covered it, and people lined up. They camped out overnight to get the first Krispy Kreme
Bramo
donut.
went to interview them. You can imagine how Bramo was, what Bramo was like in local news, right?
I thought this was local news.
Just go and do a fluff piece, please, Lisa.
And I was like, it's an investigative piece. What are they doing with that money? And how clean are the facilities?
Unreal. Bramo in Fargo.
Yeah, I'm enough of a Dunkin' Donut, which Krispy Kreme is just too sugary and sweet. Like Cameron Dawson, help us out here. Krispy Kreme or Dunkin'
She's
Donuts?
never had a donut.
There is nothing better than a hot, fresh Krispy Kreme donut straight from the fryer. Nothing better.
All right, they're screaming at me.
Get in the control room. Stop that, please. Let's be sure we're running at 9 o'clock today. Look for Cameron Dawson on Krispy Kreme donuts.
If you're joining us now, welcome. You missed out. Equities right now positive by 0.2%. Makes me think about this story. You see, Lilly, this is so confusing. We need to talk loads about this. So they've undercut the price of Novo with this newly approved weight loss drug, Zepbound. The drug maker said it plans to charge more than 21% less, or about $10.60 a month, so $1,060 a month for its shot, which will hit pharmacies after Thanksgiving. Wait for this. This is what kills me about this story. Lilly also already sells the same drug for diabetes under a different brand name, Mounjaro, that retails for around $37 less a month. Can someone make... It's the same active ingredient, Brammer. What's it about?
I have no clue. Is it insurance? Is it marketing? I have no clue.
If it's about diabetes, it costs one price. If it's about weight loss, it costs another.
Policy prescriptions? I don't know.
We got to get Sam Fazili on this. Seriously.
Yeah,
I mean,
it's really good to see you.
Good to see you.
Good to see you. Don't run. Cameron Dawson and New Edge.
Would you like
New
a
York
donut?
City.
Yes, please.
This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
In the last debate, she made fun of me for actually joining TikTok while her own daughter was actually using the app for a long time. So you might want to take care of your family first.
Leave my
before
daughter
appreciating
out of
anybody
your
else's
voice.
adult daughter. The next generation of Americans are using it. And that's actually the point. You have her supporters propping her up. That's fine. Here's the truth.
You're
The
just
easy
scum.
answer is actually to say that we're just going to ban one app. We got to go further.
Tense exchange there. Republican presidential candidates Vivek Ramaswamy and Nikki Haley feuding on the debate stage yesterday evening. That was quite a fight, Tom.
Ugly.
You're just
Ugly.
scum. It's quite a line from Nikki Haley to Vivek Ramaswamy.
I'm sorry, you know, we all deal with this, Brammo and I and everybody else, John, you
So
know,
are you doing the
can't-
commercial breaks with each other?
No, you can't. You can't drag your kids into this at any level of debate.
Totally agree.
It's like
totally agree.
third rail.
Totally agree. That crosses a line.
Yeah, it crosses a line. In
Without a
America,
doubt.
it crosses a line.
I think it crosses a line worldwide, Tom, for that matter. If you are just joining us in your equity market at the moment, we are positive by 0.2% if you round it up on the S&P 500. Going into some important data, I think. Jobless claims just around the corner, 13 minutes away, Tom. We get some jobs data in America.
It's going to be important. The economy here really just front and center. There's been a dearth of data, but I'm going to drive it forward, John, to CPI and retail. You know, I thought they were important a week ago. I would have blathered on about them. After this equity lift and the bond market move, I can't fathom the reset we could see with some outcome of those two key reports.
Andrew Honhorst of Citi saying the same thing, that ultimately Chairman Powell so far seems fine with the strong growth we had in the third quarter.
Yeah.
Pointing to a labour market that, from their perspective at the moment, I'd say the consensus on the committee doesn't see that as a reason to be hawkish any longer. The words of Neil Dutta over Renaissance Macro. I think we still have to ask the question when we look at inflation data, what are we converging to? And Andrew Honhorst of Citi thinks we're converging around 3 and not 2. And when Jan Hatzius of Goldman is talking about the easy part being over, we've been talking about the last mile of this inflation fight being the hardest, and it's from 3 to 2. What are we converging to, TK, going into next year?
Oh, the convergence. Well, going into next year, are we there yet? Do we have a clue of January, February of next year? I don't think we do.
I don't know.
Given geopolitics,
people have got to write that outlook, haven't they?
Yeah, I just don't see it. A huge response to our donut discussion. Thank you so much for that. We'll summarize it here through the last 45 minutes of the hour. The 9 o'clock show with John Farrow will be donut-free, we're told. That's a good time to speak to Anne-Marie Horton, who's gluten-free, down in Washington, Bloomberg, Washington, correspondent. No donut talk today, Anne-Marie. I've got to go to this, Anne-Marie, because we brought it up here. There was a line crossed last night at the GOP debate. What is the ramifications of this bitterness that we saw in discussion with the governor of South Carolina?
Well, I think everyone was prepared for this, right? There's been a number of moments where Vivek Ramaswamy and Nikki Haley have had these tense exchanges. Yesterday, it felt like it went maybe a little bit over the line for some because Vivek Ramaswamy brought in her daughter to that. Remember, Vivek said that TikTok is fentanyl for social media, and then he joined TikTok. And he says this is because he wants to make sure that he's reaching these young voters, and this is where they get their news. But she's a foreign policy hawk. He goes after her and brought in her daughter, and she had a lot of issues with this. He also called her Dick Cheney in 3-inch heels, and then she corrected him and said they're actually 5-inch heels. I can run in them, which was a dig at Governor Ron DeSantis, if you're following all this controversy around whether or not he puts lifts in his boots or not. And then she also said they give me ammunition. So these were the tense exchanges. But overall, this debate was a bit more substantive because there was less individuals on the debate stage. And Greg Valliere says that's the point of this. Right. A lot of these individuals we're going to start to see them really wane out. It's not going to be these 5 potentially in the next one.
Yeah, it's real sensitive for me with the lifts I'm wearing as well. Amber Horton.
You do not need lifts.
I'm wearing them every day. Amber Horton, help me here. Help me
I
here
need
to
heels. Tom does not.
Help me to the 4th debate. I can't fathom how silly the 4th debate will be.
Well, I think it depends who's going to be on the stage. Greg Valliere's note this morning talking about it's really felt like it's between Governor DeSantis and former UN Ambassador Nikki Haley. But Governor DeSantis didn't mention once this endorsement he got, a crucial endorsement from the governor of Iowa, Kim Reynolds. He didn't mention that once, and that was supposed to be this, boost to his campaign. So potentially, will we see all 5 of these in the next debate? Maybe Vivek Ramaswamy, maybe Tim Scott don't make it to that. So potentially, you can get even deeper and a little bit more texture on these conversations. But we also should remember, there's a tale of 2 primaries happening. Last night, the individual who is way out front of all 5 of these candidates was having his own rally about 10 miles away in Florida. And that's the former President Donald Trump.
It's amazing that we haven't really talked about foreign policy all that much, given how much that's dominated the headlines for so long. Last night on the debate stage, they were pretty hard in their line toward Iran, all of the Republican candidates. And this comes as news this morning shows that the U.S. said that they had a defensive strike in Syria on certain ammunitions tied to Iranian-backed rebels. What do we know in terms of how the U.S. government stance is evolving in that frame?
Well, I think for Iran, it's really no surprise here the Republicans want to take a very hard line. Remember, it was the Obama administration that had the JCPOA with Iran. Trump came in, he got rid of that. He wanted to take a hard line on Iran. He went after Qasem Soleimani. They assassinated Qasem Soleimani. And then the Biden administration, I wouldn't say was trying to renegotiate a full-on JCPOA, but they wanted to keep status quo and just keep talking with Iran to try to keep a lid on what is going on in the region. And what you see on stage last night is these individuals going after the Biden administration for not being hard enough on Iran, because Iran is the backer of Lebanese Hezbollah, of Hamas, of the Houthis. So that is why you are seeing tough talk, not just on China and for some on Russia, but squarely on Iran yesterday. And what this administration desperately wants to do right now, the current Biden administration, is they want to keep a lid on what is happening in the Gulf. They do not want to see this conflict between Israel and Hamas in Gaza spread elsewhere.
So how does the strike in Syria by U.S. aircraft really play into this goal of not escalating this conflict?
Well, the Pentagon has made it very clear. If we are striked, and they did say they are seeing an uptick of attacks on U.S. bases in Syria and Iraq, if they are seeing that, then they will strike back. They want to make sure that they are not just showing a deterrence factor in the Gulf with 2 aircraft carriers hanging off on the eastern Mediterranean Sea, but that they will actually strike back if they are hit by Iran or some of Iran's proxies. So they are seeing an uptick. Is that all we're going to see? And a lot of this has happened in the past. It just hasn't been really out front because a lot of people haven't been focused so much on what is happening and the tit for tat that sometimes takes place in the Gulf. But people are squarely focused on it now because of what's happening in Israel.
It's totally bizarre, isn't it? We're talking about these really serious issues at the same time we're talking about whether the governor of Florida has lifts in his shoes. TK, sometimes
American
it's just
politics
absolutely
is your
ridiculous.
Any stranger,
I think politics around the world has just got more ridiculous, Tom. It's not unique to this country.
You know,
that's for sure. Which begs the question, Anne-Marie, is he wearing lifts or not? Well, why is he wearing lifts if he is?
Well, listen, there's an entire... He did an interview with someone, and the interviewer said, listen, I bought you a pair of these beautiful Salvatore Ferragamo shoes. Give them a try. And Ron DeSantis didn't even touch them. He just left them there. He said, I can't accept anything like that. There's this theory that he wears these cowboy boots and he puts lifts in them so he can look taller, because there is another theory in American politics that you have to be of certain stature in height to win. But yeah, Jonathan, it's silly. We're talking about incredibly serious issues. Yesterday, on display was not just what's going on in Israel, more funding potentially for Ukraine, where they all stand on that. Should the U.S. raise the retirement age? What are we doing in terms of Social Security and entitlements? Where are they all standing on abortion, which, if you're a Republican running, you have to realize, what is your message going to be on abortion after Tuesday night's elections in Ohio, in Kentucky, and in Virginia? And yet, there's also a little bit of silliness.
We're talking about lifts. I watched that clip, by the way, with Patrick Bet-David on the Ferragamos. AMH, thank you. Anne-Marie on the latest down in Washington, D.C. TK, you're a man who does not need lifts. What are you, 6'5", 6'6"?
It depends if the children need money. Yesterday was an ugly day. Yesterday was my iPhone broke.
Whenever I meet someone, and they meet me in person for the first time, the number one thing they always say, you're so much taller than I realised. I'm like, yeah, because I sit next to a giant every single morning.
Yeah, pretty much.
Towering over us. Coming up on Bloomberg TV, Mohammed Al-Arian, George Bory of Allspring, Matt Miskin, John Hancock, Joanne Feeney, at Advisors Capital Management. That all still to come in the next hour.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Bloomberg surveillance from New York. Jonathan Farrow, Lisa Bramwitz, and Tom King. Mr. Farrow in deep preparation. Donut discussion with Dr. Ilarian. He'll do that in the 9 o'clock hour. Futures up 9. Green on the screen. The VIX in as well. And Lisa, this gets to the data next week. CPI, retail sales, and the data now.
And you said something really important just moments ago when you were talking about how we are set up into next week and the vulnerabilities to data that surprises to the upside with respect to inflation.
You have to see there, I take the 4-week moving average. Michael McKee doesn't do that. Head of Bloomberg Jobless Claims Analysis, and he joins us with the numbers.
I got so many job titles now. It's news correspondent. 217,000, really kind of no change from last week, waiting for the revision to come up, but basically no change in jobless claims. Here we are, 220, so we go down. Go figure. It's not a surprise that we see claims go down with the auto strikes over, but continuing claims still a little bit higher, 1,834,000 after 1,812,000, and so that may be something of a hangover from the jobless claims, from the auto strikes as well.
Set us up. I want to go right to next week, Mike. How is next week's CPI retail sales combo in your world, not the equity world, bond world, in your world, how is it different and to be treated?
Well, it's a little bit different in that we have a lot more data to come before the next Fed meeting, including another CPI report. So this will be informative, but it won't be dispositive. The Fed's going to look at it and they're going to wait and see what PCE does and then what the November CPI does before they have to make a decision.
Will it inform on soft landing?
Not necessarily. It will inform. That's a good word for it. Retail sales are expected to go down for the month of October, although the control group up just a little bit. It'll depend on whether people want to go Christmas shopping early. Last year they did. This year, I guess analysts don't think they're going to be doing that. And CPI is forecast to go lower as energy prices go lower. So that would keep the Fed on track at least to a soft landing and to the idea of not raising rates again in December.
Let's inform with the data check. VIX drives lower here, a more optimistic VIX off the data, 14.39. Red and green on the screen, pretty much a churn off what we see before. Lisa, do you see any bond love here off jobless claims?
No, there's a little bit of a bid back, particularly at the front end, and basically the idea being, again, we didn't see any monsters come out of the closet. We didn't see a massive tick up in jobless claims, and I wonder if that's enough to give people conviction about some sort of soft landing. Mike, to that point, what will it take, considering that we are looking at something that does look like a soft landing, but it always looks, as I'm sure you're going to say, I hear a lot of people say, like a soft landing until it isn't?
Well, that's the problem is, how do you define landing and when do you define landing? I was saying yesterday to Paul Sweeney on Bloomberg Radio that we should maybe look at it like George Aiken, the former Vermont senator who said of Vietnam, we just declare victory and go home. And maybe that's what the Fed ends up doing at some point, and just saying, okay, we're there. Because the economy doesn't ever land, it just keeps going. Now the question is, do we have any contractions, or does the economy start to grow again? That might be the definition.
2 p.m. today, Fed Chair Jay Powell, he will be at the IMF panel. What do you expect him to say? What could he say that people are looking for that could influence where markets are?
I think the only thing the markets are looking at for right now is any kind of pushback against the idea of additional rate cuts. He came out at his news conference and said, we are not talking about rate cuts, we're not thinking about rate cuts, and the next day, rate cuts were priced in even greater and sooner. And so he might want to push back against that. But this is on global central banking challenges. He is with the central bank governor of Israel and Gita Gopinath from the IMF. So he may confine his remarks to global issues. We don't know. It's an opportunity for him. We'll see if he takes it.
How are you dealing with the debt and deficit debate every day? I want to know, Michael McKee, on the new percolation of our larger debt and our substantial deficit.
Well, here's the problem, Tom, is the debt we knew would get bigger. It's gotten bigger than we thought it would because receipts are down, and people don't quite understand why. But the whole bottom line to it is nothing's going to get done unless members of Congress decide to go after entitlements, some kind of cutback to entitlements, because the additional deficit from non-defense discretionary spending is hardly anything, wouldn't get you anywhere. And do they have any kind of courage to do that? And there hasn't been any indication that that's the case.
Michael McKee, thank you so much. Greatly appreciate it. Really leaning into next week's key economic data. This is a joy. Stephanie Roth writes in English. She writes exceptionally direct economic strategy and reports. She is chief economist at Wolf Research, and we welcome her today. Stephanie, I just got to go right to your key point. You have I love how you do this, literally like an equity strategist. You have a conviction call. Very few people want to say that right now in the great uncertainty. What's the Roth conviction call?
My highest conviction call is that inflation is going to come down. And there's a couple of factors behind that. Labor supply has been a big driver of lower inflation this year, and that should continue into next year. Female participation is a big driver, and work from home is here to stay. Immigration is another factor there. And then on top of that, we all talk about onshoring as a big driver of lower inflation, but the fact is, yeah, it's true for certain issues of national security, but we're still importing just as much goods as a share of GDP as we were before the pandemic.
The key isn't just whether we disinflate. The question is until where. And as we just heard Michael McKee said, maybe the Fed just declares victory and goes home well before they get to 2%. Is that sort of what you foresee happening, or is there enough disinflationary tendencies baked in to get us down to 2%?
I think we'll get down to slightly above 2%. I don't think we'll necessarily get to 2% next year, but we'll be close enough that the Fed can certainly pause at this point and then be cutting rates in the back half of next year. And that should be, enough disinflation, especially, we didn't really even talk about owner's equivalent rent. That should come down quite a bit, weighing on core inflation by about, 5 basis points or so on core PCE.
So given your high conviction that inflation is going to come down, do you have high conviction that we will not see the economic pain associated with that disinflation that a lot of people were expecting earlier this year?
That's the piece that's harder to have conviction on. We think that growth is going to slow down. Our base case is that growth is going to move below trend with a 1 handle in the first half of next year. Recession risks are going to be elevated until the Fed can cut rates. So our base case is that we don't have a contraction in growth, but with a deceleration in the pipeline, that could definitely be a possibility.
Frame out the Wolf Research call on real GDP out 12 months, on nominal GDP out 12 months. What are your statistics?
Sure. So we're at a little bit below 2% on GDP for next year, about 1.7, and then we're looking at inflation of about 2.2%.
Then how do you fold that into an equity call? Not that you're going to make a specific stock market call, but when you talk to Wolf Research analysts about a sub 2% real GDP, that's got to bring nominal in, right? With your disinflation call, that's got to bring revenues in, right?
Yeah, and I have to say that the analysts on balance, and of course it depends by sector, but the analysts on balance are a little bit more cautious at this point than they were at the beginning of the year. So at the beginning of this year, while the economists were all really bearish on the economy, the fundamental analysts were pretty positive.
I mean, Michael Darter was busting my chops yesterday on this, Lisa, but the bottom, the line is the top line revenue of American companies. Forget about tech and Magnificent Seven and all that. It's got to be dampened if you get a Roth disinflation call with some form of subdued real GDP. It's a tautology. It's got to happen.
Which is the reason why the economy is not the stock market and vice versa. And we keep kind of parsing through that in different ways. I want to dive a little bit further, Stephanie, into this idea that you have high conviction that we're going to disinflate, but you have low conviction or not a lot of conviction about what's going to happen with the economy and how much things will slow or even contract. What are the guiding sort of lodestones for this? And I keep going back to this at a time where people are looking at oil prices and saying they've come down enough to signal a cooling in demand, but it not falling off a cliff.
Yeah, so I mean, there's a couple of things on the growth front. So when you're looking out this year, a big surprise from a growth perspective has been fiscal, and by fiscal I really mean the IRA that played out a lot faster than expected. Chip spending that resulted in structure spending being incredibly strong. That it's not going to repeat for next year. And then on top of that, we had this hidden fiscal stimulus of employee retention credits getting paid out. So all of that should provide a slower growth economy for next year, not necessarily a contraction. And then on top of that, the consumers, this excess savings concept is largely over.
So are you saying that people are underestimating how much of a fiscal boost went into that third quarter GDP print that was a wow statistic, to quote Tom, for so many people?
Yeah, I think there was an element of that. And for all of that this year, for that matter, is people just underestimated how much fiscal was actually getting spent in the economy. And some of it was related to subsidies and private companies doing the job for the fiscal, but that all played out in 2023, which is why growth held up a lot better than people expected.
This is going to be a point of a lot of debate, especially next year when it becomes politics season, silly season, as some would say. Do you think if there is this disinflation, that the fiscal stimulus will be considered successful or not successful based on the debate and where we're at globally with trying to disinflate?
I guess it depends where you're coming from, right? From a chips perspective, like we need that. It's an issue of national security, and that's particularly important. I guess you could argue some of this fiscal stimulus was coming at a time that was just countering what was happening from a monetary policy perspective, right. and that was probably not needed.
How do you define soft landing? We've been going back and forth this morning, and this permutation of it and that, but it's like V-shaped bottom to me. It's just a stupid phrase. What is a soft landing?
So I would say soft landing looks like a 1-ish% GDP for the first half of next year, and then you kind of come out of it with around trend growth. The problem with soft landing and recession might look the same for a very short period of time.
It's a key phrase. There's a short period of time, and also I think in the old days we called that a recovery. It was like it doesn't sell on TV or radio like it should, but it's a recovery.
Well, people say, to me, this is the uncertainty, right? And we don't even understand the fiscal impulse, which is one of the big actual mysteries going forward. And to me, that I thought was the biggest interesting takeaway. That was still one of the drivers. That's off the table, though, Stephanie, right? How much of a drag is that going to be on the economy?
It should be a pretty sizable drag for next year. You're going to have all of those things moving in the opposite direction, and that'll reduce GDP by a meaningful amount for next year.
Stephanie, we got to do this. When you got a company that's 85% in debt and they're coming out with a new offering and the stock tanks, granted it's a lower price stock, but it tanks from a 10 level down to 860. I'm sorry, we got to cover this. Talk about a soft landing. AMC Entertainment out with an equity offering. There it is, $350 million a stock. We'll have more coverage on this because I have no clue what that means. The stock moves 15%. The S&P up 0.2%.
Stephanie Roth of Wolf Research, thank you so much. Looking at this AMC news, the suggestion here is that the dilution in the shares is leading to this plunge, and I wonder how much AMC is coming out on the heels of Taylor Swift and all of the Barbenheimer trends and trying to raise more equity into maybe fewer day traders and fewer kind of to the moon traders who are willing to accept it on the other side, Tom.
We got 15% equity. This is not adjusted for this new offering here. And, again, it's a very small company, but 86% is the weighting of debt with a stunning, the weighted average cost of capital here on debt, the weighted average cost of debt, I should say, is 6%. That's a ginormous number, Lisa, in this milieu.
And if they had to come to market now, it would be a much more ginormous number. What I think is interesting is that this was one of the GameStop-type darlings of the era of penny trading stocks and all of that. And now the question is, they just had this incredible quarter. They've had some pretty big hits. Can they raise a bigger equity cushion? There is a cost to pay for that, or price to pay for that, as you're seeing in the market.
I look at this, folks, and you go to a pre-pandemic chart of AMC, and it's just real simple. I went from 40 to 300. I didn't buy at 300. I loaded the boat at 200, and now I'm joining it down at 10. I mean,
did you see Barbie?
No, I'm the only one in the country who hasn't.
I saw it.
Did you see Barbie?
I did.
Did you see Taylor?
No, I haven't seen Taylor yet. Have you?
No. Who are you talking to?
I don't know. You're watching, anime. Who knows?
Well, that's TV at home. Taylor. We should just mention. Take a memo, control room. I'll mention Taylor every 12 minutes, so on TV we can run Taylor. Good morning, Taylor.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Last time I was here, I said buying oil was not going to be a good hedge for escalation there because oil had been under so much pressure before, and I think that's what we're seeing again. There's just that lack of demand, and the Saudis definitely have the ability to turn on the tap if they want. We're clearly trying to figure out how to work with Venezuela, and so far it looks like Iran's going to continue to pump oil despite the sanctions, despite the heightened tensions there. So there's not much in favor of oil right now, and I think that's a very crowded long position, so I could see that breaking lower.
That was Peter Scheer, an excellent conversation yesterday of Academy Securities, head of macro strategy on oil. We will get to that in just a minute. We were just talking about AMC, so let's lean into that and a couple other names that are moving in a significant way. AMC shares plunging after announcing that they are going to offer up to $350 million of stock. They say that the goal here is to bolster liquidity and lower debt. The shares lower now by 18% in pre-market trading to really quite a low figure compared to the $300.
Does it have a preferred tranche where Taylor gets to buy $350 million with an 8% coupon?
You want another, kind of
No, but
Taylor
I just
Swift
think this is, can we say
moment.
this? Is it because of Taylor Swift and her concert footage where she's dressed in blue and then beige? And
they did just have
on
a really
radio, we're running the 10 eras, Lover Fearless, Reputation Folklore, video.
Well, here's the thing.
Works
They
on
just
radio.
had a good quarter, and they're capitalizing on it. What I find most interesting is that this is raising equity to lower debt. Think about what a reversal that is from a couple of years ago, where every company under the sun was raising money in the debt market to buy back shares. Right. That, to me, is really notable. We'll follow that story throughout the day. Also, just some notes. Duolingo shares popping after reporting better than expected earnings. And I've got to say, the whole family does Duolingo, so I understand this. Up more than 11%. People really hooked in. They send you updates and congratulations.
I agree. It's really game-changing. And what's so important here with their global tailors, Taylor Swift has been doing Duolingo. Well, bring up the Taylor video.
All right,
Come on.
no, let's
bring it
move
up
on.
right now. Taylor
And then
uses
we've got-
Duolingo.
And Disney we're focused on as well after reporting earnings that were better than expected. A big question now of who they sell to, given what we're seeing with respect to ABC.
maybe Taylor Swift will buy Disney.
All right, moving on to oil prices. We could run it in another 14 minutes. We could run it in another 14 minutes, Tom. I do want to turn to oil because there's been a real question of how much is the demand side and how much is the supply side, given the declines in prices that we saw over the past month and then again over the past couple of days. Ellen Wald joining us now, senior fellow at the Atlantic Council and author of Saudi Inc. Ellen, to that point, Saudi's energy minister came out and said it has nothing to do with demand. This is just price manipulation. Demand is still very strong. What did you make of that?
Well, I think that he always has a bone to pick with as he calls them, the speculators. So I'm not surprised to see him talking about how, this is all a financial thing and it's all due to speculators and it's not a, supply demand issue. But I think, obviously there's always, speculation in the market. And we did see a whole lot of fund managers dumping oil futures this past week. So I'm sure he's focused on that. But the fact remains that the market is reacting to what it thinks is lower demand from China. And whether or not that's actually true, I think remains to be seen. It's always difficult to gauge what exactly is going on in China. What the market's reacting to was news that refining margins are soft and, Chinese refineries aren't making as much. And so, they're interpreting that as weak demand. Now, how does that translate into whether China reduces its imports? And there was some indication that they are going to be reducing oil imports. In fact, one of the interesting things that we've seen is that Iranian oil exports in September and October have been lower than they were in August. They hit a big high in August, but now we're seeing declines. And there's some speculation that may be due to sanctions enforcement, but it's much more likely due to declining demand from China. And we've got Saudi Arabia holding 1 million barrels a day off the market. I do think Saudi Arabia is in the best position to be able to gauge Chinese demand. And it may be that yes, Chinese demand is looking a bit soft now, but, Abdulaziz bin Salman is looking at the longer picture and the longer game, and he sees that is strong.
Ellen, with great respect to your book, which was definitive, we can take these tensions at least back to the Saudi-Yemeni War of 1934. The Ibn Saud family has dealt with this for pushing 100 years, the distance to the south. Give us the modern treatment of how Riyadh and Jeddah look at Yemen today.
Yemen is basically a thorn in their side right now. They don't like the Houthis. Any group like the Houthis, Hezbollah, Hamas, all of those groups, while you might think that ideologically there are similarities and matchups there, they are essentially a threat to the Saudi monarchy. The Saudi monarchy is like, they're like the staid old, conservative guy who always votes the same way and always says the same thing for breakfast. They're the status quo. And any group that's looking to change the status quo, even if there are similarities in terms of, say, religious extremism or religious ideology, that's seen as a threat. And what's a bit disturbing is that despite prolonged military campaigns by the Saudis and the UAE, they haven't been able to dislodge the Houthis from Yemen. In fact, if anything, they're more entrenched. And so I do think that given the fact that the Houthis are at least claiming to be involved in the Israel-Hamas conflict, it'll be interesting to see if the Saudis maybe use this as an excuse to really try to get them out of Yemen once and for all, or if they'll be a bit embarrassed by somebody else taking them out.
And then the conservative guy, as you call Saudi Arabia, their treatment of the shades of Palestine. How do you interpret that, Dr. Wald?
Now that is a big question, because what we've got on one hand is King Salman, who is nominally the king of Saudi Arabia, and he is vehemently anti-Israel, pro-Palestinian. I mean, this is a guy who thinks that, the Mossad was responsible for 9/11 and has said so, in public on television. So he is a huge barrier to any kind of rapprochement between Saudi Arabia and Israel. That being said, his son, who's really doing most of the ruling, the day-to-day ruling, seems much more inclined to use rapprochement with Israel as a way to get what he wants or what he thinks he needs from the United States. And in fact, it seemed like that was about to be a very successful deal before this latest conflict derailed all that. And I don't think that the general battle, the general lines that are drawn here are going to change. But I do think, if King Salman wasn't there, I think we'd see a much faster progression towards Saudi-Israeli normalization. I don't think we're going to see quite what the UAE or Jordan has, but I do think that MBS sees it as a beneficial thing, or at least a really good tool to get other things that he needs, like support for obtaining nuclear power and military pact with the United States.
Just real quick here, how does Saudi Arabia view the production in the U.S. that's gotten to a record level amid all of these concerns about demand?
I think that they have kind of come to terms with the fact that the U.S. is going to produce what the U.S. is going to produce, and there really isn't much they can do about it. I think they were probably pretty pleased to see that there's more consolidation in the oil industry. I think that they see that as good for production and for companies who are looking at the signs of supply and demand and aren't just pumping just to stay ahead the way that we saw in 2015, 2016. And so I think that they see this as, this is where it is right now, and it's not always necessarily going to be this high.
Ellen, a wonderful brief, particularly those comments on Yemen. Thank you so much. Ellen Wald, Atlantic Council. Can't say enough about Saudi Inc. It is absolutely definitive. I got equity markets with a lift, and a lift here through the morning that is tangible. Those small stocks up 0.7%, and the VIX just giving me love, 14.3. So all that is shadowed by the 30-year auction today. Bramo dead on about the 10 years, celebrated, I would say. I would editorialize yesterday. Ian Lingen weighing in here. Let's do this one more time. It's so important. New 30-year auctions have a very long history of tailing, leaving the only directional impulse from the event is the magnitude of the tail. We go on here. What are we going to see this afternoon?
To translate, it is a question of whether the buyers show up at the price that dealers and the initial buyers think they will.
I need a prediction. Bramo editorial.
Yesterday, we saw strength, or we saw a pretty solid auction. Today, 30-year bonds, and what Ian was saying there is a history of a little more indigestion at 30-year auctions. So it's going to be potentially more interesting to watch.
Please stay with us through the day. Our team coverage at 1 p.m. of the 30-year auction. Airbnb in the 12 noon.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. 8-day winning streak on the S&P 500. Futures positive. Can we make it day 9? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, Ken Griffin says high inflation is here for decades. As Fed Chair Jay Powell takes the stage once again, Yellen is kicking off 2 days of talks with China. We begin with the big issue, an 8-day winning streak.
This rip-roaring equity market rally in the S&P
has been a well-deserved sigh of relief.
Relief rally after such a dismal couple months.
The stock market rallied because the bond market rallied.
There's a bit more reason for investors to be a bit more optimistic.
Now we know that major central banks are on hold.
Fed is done hiking.
We expect the market to continue to rally.
Rally into the end of the year.
Move higher to your end.
Historically, when you have a weak or a negative August, September, October, you have an up end of the year, November, December.
It looks to us like it's a bear market rally and not something that's sustainable.
There is space for negative surprises in the earnings picture for next year.
We should still be prepared for a larger pullback or mild recession coming.
It's not going to be a straight line for the stock market.
We haven't really written the entire story just yet, so we'll see how it unfolds from here.
Let's have that conversation right now with Mohammed El-Erin of Queen's College, Cambridge. Mohammed, what a rally in the equity market inspired by a major bond market move. Your piece this morning, let's get straight to it. This line right here, for all of us who hope for greater certainty and less yield volatility. Mohammed, how disappointed are we going to be?
Thanks for having me, John. First, the rally has been driven not just by lower yields and a ton of refinancing that has allowed the capital structure to be strengthened for companies, but also by lower oil prices. Don't underestimate the impact of oil prices, both on the supply side and on the demand side, when it comes to the tip of a company. Now, we all want more stability in the treasury market. The treasury market is central to so many other markets, and having 8 to 15 basis points moves every day as something regular is not good for the functioning of that market. It's not good for other markets. It's not good for the economy. It's not good for the standing of the U.S. in the financial system. So we all want greater stability. The Fed is moving off center stage. the Fed is going to have much less of an influence on where rates go from here. But unfortunately, that doesn't mean that the volatility is going to go away, because you have a tug of war that we're going to see playing out between issuance and between a softer economy. And that tug of war means that we're going to continue to see this volatility. But I don't think to the extent we've seen it before, because the Fed is not going to be confusing things anymore.
So do you think we are confusing a rally in the bond market with stability?
Well, it hasn't even been stable, John. Yesterday, we moved 8 basis points, and the stock market did nothing at all. But the bond market is still moving. There's still a lot of underlying tensions in that bond market. Issuance, John, I'll give an example that comes from a colleague at Gramercy. For the whole of October, there was 14 billion of issuance in emerging markets. This week alone, there's been 14.5 billion. So this week alone, everybody has rushed, understandably so, to issue because the volatility had kept them on the sideline. So the issuance element is contributing to what we see volatility, even though I agree with what most people will think, which is the Fed is done. It certainly should be done, and I suspect it is done.
Let's build on that, Mohammed. We've had a lot of EM issuance, a ton of credit supply, corporate issuance in America, Treasury too. Can you speak to whether that's been received well, how well that's been received, and whether we can take comfort from that this week at least?
So far it has been received, but I don't think we can take comfort from it. It has been received because away from treasuries, issuance has been quite low in the last few months because of the volatility in the market. Going forward, there's a lot of issuance that has to be done. There's a lot of issuance by the government that needs to be done. And John, there are question marks about the buyers. The Fed is not a reliable buyer anymore. In fact, the Fed is reducing its balance sheet. Japan and China have internal issues going on that makes them fewer buyers. And some institutional investors and banks are still sitting on quite huge losses from treasuries. So I think we are going to be learning a lot about auctions. We're going to be learning a lot about refunding announcements. This issuance dynamic is going to be with us for the next, I suspect, at least, John, 15 months.
So 2 questions I have for you, if that is the case. One, is the Fed done? You think either it is or ultimately it should be. So let's leave that there. Let's get to this piece of the question, Mohammed. Have we seen the high for yields for this cycle? The move that we've had over the last couple of weeks is about 50 basis points, a break of 450 yesterday on the 10-year, down from 5%. Have we seen the high for the cycle?
So we've seen the high, okay, for the Fed. And I would say that's important because Ken Griffin is right. We're living in a more inflationary global economy. You've heard me say it's no longer about insufficient demand, it's about insufficient supply. Now, why is the Fed done? Because they're going to get the air cover from headline inflation coming down very rapidly. So even though core inflation is going to be sluggish, they're going to get air cover from headline inflation. As to the rest of the curve, this is going to be about the further out you go in the curve, the greater volatility you're going to see as you get this tug of war playing out. And it's too early to tell how that's going to play out, John.
Well, you said Ken Griffin's right, so by extension, I wonder if you think Goldman Sachs is wrong. The team over at Goldman, led by Jan Hatzius. Let me share some bullet points with you, Mohammed. I'll go through them right now. Their outlook for 2024, they say the hard part is over, more disinflation is in store over the next year, the full disinflationary effect is still playing out. Core inflation should fall back to 2 to 2.5% by the end of 2024. They continue to see only limited recession risk going into next year and increased willingness of central banks to deliver insurance cuts if growth slows. Mohammed, what would you say back to that?
So I do think we're going to get more disinflation at the headline level, and it's going to be quite sharp disinflation. I would disagree with them on the notion that core is heading to 2%. I suspect core over the next couple of years is going to be more around 3%. John, we have some real things happening on the supply side that are going to play out over a number of years. You've heard me talk about it. You have the fragmentation of the global economy. You have non-commercial consideration driving supply chains. You have companies building more robustness in their supply chain. You have the energy transition. All that is inflationary. That's not going to go away anytime soon. So I would push back against their 3%, their 2% core, and say core will probably get stuck more around 3%. As to what central banks will do, deep inside, I think at the end of the day, and you and I have discussed this, they will keep on promising us 2% down the road, and we will run with slightly higher core inflation, and we're going to find out that it's stable.
We'll hear from Chairman Powell a little bit later. For those of you just joining us going into the opening bell, equities positive again this morning by 0.2% on the S&P 500. This is an 8-day winning streak on the S&P. We make it day 9. It's the longest winning streak going back to 2004. Mike McKee, plenty of Fed speak still to come a little bit later.
Yeah, Chairman Powell at 2 o'clock this afternoon, so we'll see if we make that 9th day or not. The problem for Jay Powell is that Wall Street hasn't been listening to what he had to say. This is what he said in his news conference following last week's Fed meeting. The fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. What happened? Well, the day after he said that, the market priced in more rate cuts and sooner. So the Fed and the markets are somewhat at odds right now going forward. The Fed doesn't have to make a decision right away. The markets reprice every few minutes. So then does the Fed chair need to push back, or does he stay away from the current economy at all? Because this is a panel on international problems, monetary policy challenges in a global economy with Israel's Amir Yaron, Ken Rogoff, and Guido Gopinath from the IMF. It's not necessarily going to be a situation where he wants to talk about the U.S. economy, but we shall see. And if he does, or if all of these people want to talk about, in general, the problems they face, you can see here what they are. Manufacturing starting to slow, the white line. Inflation, the blue line, is still high, even though it has been coming down. And the economic surprise index for the world has been up and down, but trending lower. So they all have kind of the same problem. Does Powell stick to that, or does he want to send a message to his markets that they're going the wrong direction too quickly?
The title of that, is that global meh? Is that what that says, Mike?
Global meh.
Global meh.
That's kind of
like
the way you could describe it now, yeah.
Nice, nice. Mike McKee, thank you, sir. Mohammed, some final thoughts, please. Let's not go to global meh. Let's talk about something a little bit more important than that, how quickly this narrative has shifted. And you identified 2 points, not just the bond market, but also in the commodity market. I think it's really key that yesterday we had a break of 450 on a 10-year at the same time that Brent crude broke below 80 and into the 70s. Mohammed, are we getting to a point where we start to think more about maybe a growth slowdown that is less friendly to risk assets, equities, credit, etc.?
Yeah, that's the big fear, that interest rate risk goes away and then credit risk comes center stage. John, I do worry about 2024. I worry more about 2024 than I worried about 2023. I remember when Bloomberg Economics came up with recession is 100% likely, probability, and I said no, it's not at all. In fact, we can avoid a recession. I'm not so sure about 2024. Savings have been run down. There's a cumulative impact of higher interest rates. The global economy is more sluggish. 2024 is going to be a tougher year than 2023 was for the global economy.
For the global economy and for markets too?
It's an interesting one, John. I suspect that we will see an enormous amount of dispersion, an enormous amount. And so I hesitate in answering your question because it depends which market. If you're in private credit, you're going to have a lot of opportunities as good borrowers find themselves rationed in certain markets and look to the private markets. If you're in public markets, it's going to be pretty volatile.
Hey, Mohammed, we've got to leave it there. It's always great to catch up, buddy. As always, Mohammed Al-Erian on the latest for the global economy, for markets, for central banks as well. 20 minutes away from the opening bell. Equities look like this on the S&P 500, pushing higher by 0.2% with some movers going into the open. Here's Abby.
Well, certainly helping out the gain, at least right now, John. We do have the shares of Disney popping higher. This after a very strong quarter that they reported. They beat earnings by 19%. There was a slight sales miss, but that profit comes amid the cost-cutting plan. And Bob Iger, CEO over there, is signaling another $2 billion could be cut soon. And this, of course, ahead of Nelson Peltz's cost-cutting push on the board. Theme parks and streaming, a smaller loss for streaming, helping out that profitability. NVIDIA higher amid some of the FOMO that you're talking about, this 8th up day for the S&P 500. Plus, there's a report that they may be releasing 3 new AI chips to China, but not joining the party. Tesla, it's down, and HSBC has launched with a reduced rating, saying that overall they believe in CEO Elon Musk and that they do what they say, but they're a little bit nervous right now about the timing of deliveries of those EVs.
Stock down 1%. Abby, thanks for that. More from Abby around the opening bell. Coming up, investors bracing for day 2 of Chair Powell after a quiet day 1.
Even with state-of-the-art models and even in relatively calm times, the economy frequently surprises us. But our economy is flexible and dynamic and is subject at times to unpredictable shocks.
Looking ahead to Chairman Powell with Allsprings, George Bory, Matt Miskin of John Hancock Investment Management. All of that still to come.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economic models do a reasonably good job of capturing the working of the economy over past decades. Of course, even with state-of-the-art models and even in relatively calm times, the economy frequently surprises us. But our economy is flexible and dynamic and is subject at times to unpredictable shocks, like a global financial crisis or a pandemic.
That was yesterday, Fed Chair Jay Powell giving markets very little to chew on. Potentially a different story today, with investors bracing for fresh remarks at 2 p.m. Eastern Time. Speaking at an IMF panel in Washington, D.C., here's why Mohamed Al-Erian thinks the Fed might be done.
Why is the Fed done? Because they're going to get the air cover from headline inflation coming down very rapidly. So even though core inflation is going to be sluggish, they're going to get air cover from headline inflation.
Let's continue that conversation. John Hancock's Matt Miskin, Allsprings, George Bory. Matt, do you agree? Is the Fed done? Is it all over?
We do. And, I think what's interesting is the core conversation there, because what we're seeing in core is that 70% of core inflation has been driven from shelter. And housing is going to be really a big part of that. And right now, the Bureau of Labor Statistics is still calling housing prices up 7% year over year. Data we're seeing from like Zillow or other resources are looking more like a flat year over year. So we actually think core is going to be coming down. Headlines still going to be whipped around with gas prices, but there's a lot of disinflationary developments as of late. We think that is going to help inflation get lower into 2024. And we think as a result, the Fed doesn't need to raise further from here.
What's the price we've got to pay to get inflation lower from here? George Bory, is it too early to get comfortable with this somewhat painless retreat in inflation?
It is a bit too early. I mean, as we just heard, kind of there's good indicators to suggest inflation continues to creep lower. So directionally, inflation is pointing in the right direction, which does give the Fed air cover. But as we know, what the Fed does is important, but what we think the Fed will do is really what's most important. And so where the Fed has air cover right now is that the market believes that they want to ultimately get to their target. And so while they don't need to raise rates any further, at least not at this juncture, and they've been in this holding pattern now for almost half a year. And then the need to do so, to move, is really non-existent right now. But what Powell and the team are doing is they're playing a sort of a mind game, if you will, with the market. They need the market to believe that they will move if they need to. But in reality, the data is telling us that they can sit pat for the foreseeable future.
And when we talk about the data, we're also talking about the labour market data. I've seen this line from Citi's Andrew Holdenhorst, from Neil Dutta of Renaissance Macro, that ultimately the labour market is not a reason to be hawkish anymore. Matt, let me frame it a different way. At what point does the labour market become a reason to be bearish?
Yeah, so bad news is going to be bad news at some point. It's been amazing, this good news, bad news, and then now bad news, good news development. I mean, last week, it was just such a reversal. Like you said earlier on the show, I mean, it's just such a narrative merry-go-round here. But so now we're in bad news is good news. But the thing is initial jobless claims, if they actually start rising, high yield spreads, if you overlay initial jobless claims with high yield spreads, it's the same thing. It's the last thing to go. And the best coincident indicator you can use for the economy. And for now, it's low. We just got it this morning, 217,000. But look at the continuing claims. When we look at the labor picture right now, what we're seeing is there's hiring, but the hiring is really concentrated in government jobs and healthcare. You take that out, there's not a lot of hiring right now. And we actually think the labor market's really deteriorating underneath us. And we think it's not showing up yet in initial jobless claims. But as we get into 2024, we think unemployment rate rises and we think high yield spreads widen. And that's when stocks are not going to be happy about it.
Matt, you think we're late cycle. Goldman thinks this cycle can continue through 2024. I'm just reading through the note from Jan Hatzius again. I suggest if you can get hold of a piece, everyone should have a read of it. It's incredibly constructive. They're talking about tailwinds to global growth in 2024, only limited risk of recession. Matt, I'm sure you're taking the other side of this, but what do you think they're getting wrong?
So we haven't had a recession in 12 years. It's almost like we have to go back and think about traditional monetary policy cycles. After the Federal Reserve raised rates significantly, and we just went from one of the easiest monetary policies and fiscal policies in this country's history to now a whipsawing to the most tightening we're seeing in other than 1980. So we have gone from easing to tightening really fast, 3 years. And I think what's often misunderstood or misplaced is just saying, hey, Fed can raise rates a lot and the economy's just going to be fine. There's no lagged impact of monetary policy. We'll take the other side of that. You look over the long term, after the Fed raises rates a lot, eventually the economy slows down. We still think that's in the pipeline into 2024.
The labour market call here is key for next year, for 2024. George Bory, Torsten Slock of Apollo wrote this morning. He said, everyone who is bullish on equities and lower rated credit should ask themselves where they think the labour market will be in 3 months, with the Fed on hold and not showing any signs of cutting anytime soon. George, as you start to add a little bit more duration, go out further along the curve on treasuries, George, how are you thinking about developments in the labour market as you do that?
Well, as we know, labor obviously is the main driver of the economy, and as we just heard again, it's not as binary, we think, as many are kind of making it out to be. Monetary policy works, and it will be a persistent headwind. And it is a bit surprising that the economy is holding up as well as it is. But there are two big factors. One is just the starting position of consumers. Defaults are ultimately driven by, inability to pay. So there's a combination of earnings plus whatever you're needing to refi into. That pressure mounts as we move through time. But starting from a good spot for both many individuals as well as corporations, having a lot of low-cost debt on their balance sheets, it's a big help. And so when we think about next year, labor matters. Absolutely, labor matters. But we think growth slows, but it doesn't necessarily result in a recession or a hard recession. We could have just slow, sluggish, kind of zero type growth for quite a while as the heavy cost of borrowing, the heavy real cost of borrowing kind of weighs on individuals, weighs on corporations, and kind of slowly gnaws its way through the balance sheets. One thing about inflation is it's not a universal bad. Many companies, some individuals actually benefit from a higher inflationary environment. And so it's this big rotation, both from an operating standpoint, financing standpoint, and ultimately the economy, which is what we're working through. So we're not convinced that it has to be this binary, really hard, really soft landing. It could really just be a sluggish, ungratifying landing, which a little bit of duration and a little bit of credit can do very well, especially given where yields are. If investment grade yields are up around 6% and high yield is up around 9.5%, there's a lot of income there to cushion you against that rate ball and still absorb some of the credit risk.
George, we've got to leave it there. George Bory, Matt Miskin, reminds me of that line from Kit Jukes at SocGen this morning. Yields and the dollar might have peaked. Frustration levels haven't. Coming up, the morning calls, and later, stocks looking to match their longest winning streak in nearly 2 decades.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Equity slightly positive. Let's get you some morning calls. First up, HSBC initiating coverage on Tesla with a bearish reduced rating, pointing to challenging delivery targets and overly optimistic investors. Next up, Evercore adding 5 below to its analyst outperform list, expecting shares to rally heading into the holiday season. And finally, Wells Fargo raising its Disney price target to $115, expecting shares to benefit from further cost cuts and improving free cash flow. That stock is up 4%. Coming up, fundamentals, fear, and the Fed. Why Joanne Feeney is calling them the 3 keys to the markets. That conversation is just around the corner. Your opening bell, up next.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City,
From London and Sydney.
from Washington,
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg.
What a rally, what a rally. Let's set the stage for you. 20 seconds out from the opening bell this morning. Good morning to you. 8 days of gains on the S&P 500. You know the numbers by now. Longest winning streak going back to November 2021, 2 years. You make it day 9, it's the longest winning streak going back to 2004. Equity so far a little bit higher. There's the opening bell. Switch on the board and get to the bond market. Yields look like this morning, higher by 4 basis points. Your 10-year, 452.94. Yesterday, a break of 450 in the other direction. From 450 to 452. Think about where we were before, 5%, north of 5%, and then a break of 450 in just the last couple of days. Only a few weeks ago, we had a 5 handle on that 10-year yield. In the FX market, the euro not really doing much at all, 107. Yesterday, when I was looking at that move, breaking 450 on a 10-year, I was looking at Brent crude breaking 80. WTI is still in the 70s, 76.15. We're positive there by 1.1%. About 30 seconds into the session, here's day 9 on the S&P 500, another day of gains. The S&P advancing by 0.2%, the Nasdaq up by 0.25%. One stock to watch at the open is Disney. Shares moving higher after topping Q4 profit estimates. Bob Iger looking for sustainable profitability in our streaming business, building ESPN into the preeminent digital sports platform, improving the output and economics of our studios, and turbocharging growth in our parks. With more, here's Abby.
Well, investors liking this quarter quite a bit, John. We have the stock on pace for its best day since August 10th, and now higher slightly on the year as well. Going into this print, the stock had been down a little bit on the year, and has everything to do with that profitability. They did post an adjusted earnings of 82 cents. That's 19 cents better than the street. Slight sales miss, but profitability is really important because it signals the cost cutting that they've put into place, that it is working. And in fact, CEO Bob Iger signaling that they will cut another $2 billion, and a piece of it, the parks that you were talking about, and also streaming, a loss that was smaller than had been expected. In fact, the flagship theme parks, going back to parks, delivered the biggest profit boost, earnings rising by about 31% for the period ended in September. But it's not all unicorns and rainbows, or whatever the saying is, because there is, of course, a battle to some degree looming with activist investor Nelson Peltz. He is seeking several board seats, but I think that in terms of the profit that was delivered and the cost cutting that is perhaps to be put in place still, that $2 billion, well, maybe maybe there's something that Bob Iger and Nelson Peltz can agree over, John.
The stock is up by something like 5% this morning. Abby, thanks for that. Let's stick with earnings and check out Lyft. Delivering a lackluster forecast. The CFO saying this: our Q4 outlook calls for continued progress, and the updates we're making better align our reporting with our strategic priorities. Eduardo joins us for more. Morning, Ed.
Yeah, morning, John. Lyft dropping hard out of the open, down more than 6%. The story is a beat in the quarter gone, but the guidance into that December quarter is really worrying the street about how Lyft catches up with Uber. Sales rose 10% in the September quarter to 1.16 billion, and the guide is a mid-single digits quarter-over-quarter gain into the December quarter. The average analyst projection into the end of the year is 1.19 billion, so that's now a big question mark of whether they'll meet that. We learned quite a lot about Lyft's business because of the new metrics that they are now sharing, including gross bookings. Those grew 15% year on year to 3.55 billion. But they're also telling us about their ridership. It isn't just ride share, but also scooters and bikes on the platform. Rides overall up 20% to 187 million, and then ride share distinctly up 22% year on year. There's a real concern about the take rate because of how heavily Lyft is discounting in order to catch up with Uber. In other words, they're not really booking the revenue per gross booking that Uber's able to get to, and also their cost base is just much higher than Uber. So it is a concern, and I'll ask the CEO about that later on my show, John.
Well, Ed, you also spoke to Uber earlier on this week, so let's build on that. What is Uber getting right that Lyft's getting wrong?
Big difference is supply. They're able to bring in the drivers, partly because of their diversified business, right? Supply was boosted for Uber 32%, because if you're a driver, you have the incentive of, when you're not doing rides, to do food delivery. Lyft has really struggled with supply, so it's discounting heavily, but it also can't grow its volumes in a meaningful way, and that means, and it's reflected right in the revenue forecast going into the end of the year. They're going to have to do a lot of belt tightening, but also think smartly about how they grow their business too.
Ed, thank you. Stock is down about 6% this morning, about 4 minutes into the session, just about holding on to day 9. Day 9 of gains on the S&P 500, up by 0.1%. Let's turn to the pharma space. Eli Lilly gaining US approval for its diabetes drug to treat obesity. The FDA writing this: in light of the increasing rates of obesity in the United States, today's approval addresses an unmet medical need. Katie has more. Hey, Katie.
Well, you look at shares this morning, they're down slightly, but that's after they closed at the highest level since Eli Lilly went public in 1980 after getting that nod from the FDA yesterday. The regulator said that in trials, patients who received the highest dose of Eli Lilly's Zepbound, that's what it's called, lost an average 18% of their body weight, which is quite a lot. Now, Zepbound, it'll cost $1,060 for a 1-month supply. That is cheaper than Novo Nordisk's Wegovy, and Eli Lilly says that this will be available soon after Thanksgiving. And John, to call the hype around these weight loss drugs a frenzy would be an understatement. Both Eli Lilly and Novo Nordisk are trading near their all-time highs right now. This market overall is expected to be about $100 billion by 2030. And Eli Lilly right now, you can see, down almost 3%, but this stock is nearly 67% higher year to date.
What a move. Katie, thank you. I find this story absolutely fascinating. What these drugs are going to do to this country and what it's ultimately going to change about our eating habits and how that's going to change some of the stories out there in food packaging companies, food companies in America. That's one to watch through 2024 for sure. Let's turn back to earnings. MGM Resorts topping estimates despite a cyber attack in September. The CEO with this to say: while we were faced with a difficult cybersecurity issue, we are a stronger company having been through the challenge. Simone Foxman has the story. Hey, Simone.
Yeah, hey, John. MGM Resorts really hitting some winners here in the third quarter. Not only seemingly able to overcome that cyber attack with bookings returning to normal in Las Vegas in October, but also topping numbers in third quarter. Earnings per share coming in at 65 cents versus the expected 45 cents. Revenue, $3.97 billion. That's about $100 million more than the street was anticipated. Seeing better than expected performance out of China, but also above expectations in the Las Vegas Strip, which, although it's down about 8.5% year on year on a revenue basis, is the company's largest geographic segment. Also, shouldn't note that the company announced a new $2 billion buyback program. So that could be some of what we're seeing, giving the stock a lift today. Macro-wise, the company's seeing some softness in China, but not really super concerned about macroeconomic headwinds gains elsewhere. And on top of this, we got some decent news on the labor front. So there's a union of Las Vegas hospitality workers that's been really about to strike, but they seem to have struck a tentative deal with Caesars. MGM executives on the call also signaling that they're close to a deal. So despite the fact that shares are down about 20% since hitting a high in late July, we're seeing some enthusiasm this morning. Shares up about 2.4% on a little bit better outlook for its hospitality business than I think everyone was fearing.
Simone, thank you. About 7 minutes into this session, these are the scores right now. We're positive by just 0.01%. You hold on to those gains, it's the longest winning streak since 2004 on a daily basis. Here's Evercore's Julian Emanuel on what's been driving this latest rally.
In this world now, for the last year and a half, where stocks and bonds have been positive correlated, if bond yields go down, stocks go up. And backing off of 5% was huge for the psychology.
Joanne Feeney of Advisors Capital joins us right now. Joanne, let's get straight into it. Massive move in the equity market, inspired, supported by developments in fixed income. Was it just about fixed income? Is it something more? And how sustainable do you think it might be?
Well, John, I certainly think that the drop-off in interest rates was coordinated with the investor renewed enthusiasm for risk on assets. We saw a big drop-off over the course of the summer, in enthusiasm for company stocks because of the earnings reports that they feared were going to come out weaker than expected. And it turns out we got better than expected earnings. But as we'd like to say in some areas of life, what have you done for me lately? In stocks, it's what are you going to do for me in the future? And so it turns out it's all about guidance. And we're seeing investors now look forward to 2024. And with the economic data coming in a little bit better than expected, maybe we're not going to see interest rates stay as high for as long. I think that's a little bit of a misread of what the Fed is up to, but I think that's where investors are in the market.
Joanne, what do you think is a misread?
I think that the cuts that the market has priced in are probably a little bit premature. I mean, the Fed is trying to make it really clear that it's very focused on that 2% target and that there's still work to be done to get there and that they're not going to ease off their plan. So I think higher for longer, unless something breaks, is probably what investors should be thinking about. And we even saw folks from the Fed come out, since Powell's press conference trying to reverse some of the decline in interest rates and some of the cuts that got priced in. I think that was a bit of a mistake on the part of investors.
Well, let's go back to a question that Torsten Slock of Apollo is asking this morning. If you're bullish on stocks, if you're bullish on credit, lower rated credit specifically, you've got to ask yourself where you think the labour market's going to be in 3 months. John, this was a question that I asked the likes of Julian Emanuel this morning, also Matt Miskin as well. At the moment, people are pointing to the labour market as a reason for the Fed not to be hawkish. When do you start to point to the labour market as a reason to be bearish?
Yeah, so right now we're still in a situation where the labor market's pretty tight. It's gotten a little bit better, but it's actually hard to parse the data. And on the one hand, yeah, fewer hires suggests perhaps that the labor market is loosening, and so there'll be less wage pressure, and so the Fed has less work to do. On the other hand, it could simply be that firms are running out of workers to hire, and that's why the numbers are dropping a little bit. So ultimately, you have to look through the actual numbers of people being hired to the wages and employment cost index. And we're still seeing pretty significant pressure there, pressure that's not quite consistent with 2% inflation. So you asked the question, when do you become bearish? Well, I think right now it's premature to assume that we're going to see cuts anytime soon, because the pressure still seems to be coming from that labor market. And so we have to be cautious. That doesn't mean you don't want to stay well diversified and exposed to equities, because over the long term, those are still going to serve your portfolio well. You just want to be a little bit careful about where you have your exposure at this point in time.
Well, talk to me about where you want to do that. Where do you find protection within equities?
Yeah, when we talk to clients, they get a little bit nervous about what's happened over the last year, the market being driven by 7 companies, right, for much of the year, and income-oriented, dividend-paying stocks being down, the average stock being down. And what they eventually recognize is that when they own companies that provide protection against recession, when they own companies that provide dividends, that can sustain them over the long term. So protection in this kind of a market, you own something like a TJ Maxx. You own something like a McDonald's. Even with the weight loss drugs, we think McDonald's is going to hold up just fine. And you can also own some higher income payers, whether it's an AbbVie or a Cisco or an IBM, that still give you some appreciation potential because they're long-term growers, but also give you much higher than average dividend yields to help carry you through the stock price volatility.
Joanne, why don't you think the likes of Novo Nordisk, Eli Lilly, aren't the McDonald's killer that other people think it is?
Well, because you have to ask who's going to get access to these drugs first. And, you know, folks lower down the income scale may not get as much access as wealthier folks with more generous healthcare plans. So these are expensive drugs. It's not clear who's going to get access to them and when. And so that's one reason. Another reason is, you know, if you kind of have a bigger budget in terms of calories because you know you're getting this benefit from these drugs, it's not clear that's going to stop you from going to McDonald's. Also, it's a very cheap source of protein. It's a very cheap source of food. And when you're on a tight budget and, you know, you're going to try to feed your kids, you're going to keep them happy, unfortunately, that means a lot of people end up going to McDonald's. And I don't think that's going to change very much, given how these drugs are priced for now.
About 13 minutes into the session here, just about holding on to these gains on the S&P 500. Joanne, let's finish on tech. Tech this year, the likes of Meta up by 166% year to date. Nvidia up by 224. Meta has gone through all this cost cutting expenses and still getting all of this growth on the top line as well, and on the bottom line for that matter too. Joanne, can you just talk to me about what you like in tech right now and what you don't like? Because one thing that jumped out for me, particularly after ARM earnings just yesterday, forecasting some pretty soft revenue, at least the midpoint came in below estimates. You think this cyclical smartphone decline is nearing an end. Joanne, why do you think that's the case?
Well, we're seeing inventories clear, for one thing. We went through, it's been a long time since folks bought their smartphones at the depths of the pandemic. They upgraded their technology, and we've seen now that drop off a cliff, right? But it happened a long time ago, like probably 4 to 6 quarters ago. And we're starting to see the inventories of the parts that go into smartphones really come back down to normal levels. So that tells us that's been absorbed. We're also seeing, you know, lots of signals out of Asia where these phones are built that they're starting to pick up a little bit. So the ground level data is telling us this is starting to recover. And the same thing is happening with PCs. But beyond that in tech, right, what you want to think about is what's going to happen over the next 5 years. And so the companies that are enabling, right, this adoption of AI and all sorts of applications, companies like Microsoft, you know, this is one of our favorites. Amazon, we think, is going to start being a user, and they just talked about a new large language model that they're going to deploy. So we think there's just a lot of applications that have yet even to be invented that we think these big cloud providers like Amazon Web Services, Microsoft, Google are all going to enable. And we think that's a good thing, a good area to own for the longer term. And they're also able to control their costs and deliver incredible free cash flow, which they can use for a little bit of a dividend or to buy back shares or to reinvest in growth. So very solid business models in a growing area of the global economy.
Joanne, we've got to leave it there. Great to get an update from you, as always. Joanne Finney there of Advisors Capital. This is going to be so tedious today. We're about 15 minutes into the session. We've got really, really muted gains on the S&P 500. And as you know, if we close positive today, it's the longest winning streak on the S&P 500, day 9, going back to November 5th, 2004. Just about positive at the moment. Coming up, Secretary Yellen preparing for 2 days of talks with China.
Foreign companies are incredibly important for the Chinese economy. And right now, they're trying to reverse the cycle of exodus.
Team coverage up next.
Do you see a future for Monumental as a public company?
Yeah, I think so.
I think what we found is the leagues have opened up to new pools of capital over the last year or two. Both the NBA and NHL have allowed professional investors to come in, not as individual owners, but as funds. So that's a whole new pool of capital that didn't exist before. Sort of shows a whole new asset class opening up for professional sports, not just teams, but professional sports enterprises.
I think the sophisticated analysts will be looking at this industry, and as our revenues start to get in the billions of dollars, yeah, I think that you'll see a wave of companies go public. Whether we will or not, there's a big responsibility when you're a public company. And I tell people, we're a public company already. The scrutiny that you're under in running a sports team is, I think, much higher than a public company CEO has to live with. We'd be prepared to do it. Just the market would have to be right. We'd have to emotionally be ready to do something like that. But I think Monumental will be one of the 3, 4, 5 best-in-class organizations that, if that time was there, sure, we could go public.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Foreign companies are incredibly important for the Chinese economy. And right now, they're trying to reverse the cycle of exodus, that everyone essentially is blowing out of China because there's no confidence that that is a profit center for companies going forward. And China's trying to say, hey, we have a friendly environment for you guys. Come on back.
That was Bill Lee of the Milken Institute. Secretary Yellen kicking off 2 days of talks with her Chinese counterpart in San Francisco. This coming ahead of a long-anticipated meeting between President Biden and Xi Jinping next week. The White House facing pressure to hike tariffs on vehicles made in China. A bipartisan group of lawmakers writing it is critical that tariffs on Chinese automobiles not only be maintained, but also increased to stem the expected surge in Chinese imports. Your team coverage starts right now with Bloomberg's Anne-Marie and Katie Lyons down in Washington, D.C. Katie, walk us through the next couple of days.
Well, it begins today when Treasury Secretary Janet Yellen is going to be meeting with her counterpart, He Lifeng. And of course, the issue of economic competition is really going to be front and center, which speaks to the idea of the tariffs still in place on Chinese goods that were put in under the Trump administration. And the Biden administration to this point has not abandoned. No sign that they will. And of course, now a bipartisan group of lawmakers, notably the chair and ranking member of the House Committee on the Select Competition with the Chinese Communist Party, are even pushing for intensified tariffs. So that may set a bit of a difficult scene as Secretary Yellen prepares for this meeting. Also setting a difficult scene is the fact that China, by Beijing, by way of Chinese state media, was airing out economic grievances overnight related to the U.S., talking about the lack of a level playing field for Chinese firms, also noting that U.S. efforts to cut China out of supply chains, some of the export controls have been put into place. Beijing saying hurts U.S. firms. Of course, Secretary Yellen, on the other hand, in these meetings is likely to say the reverse, that there is an unlevel playing field for U.S. firms in China. And she is likely to reiterate what we have often heard from her and other administration officials, that the U.S. is looking for competition with China in a healthy way. It is not trying to hold back the Chinese economy, but also they want to diversify and de-risk, not necessarily decouple, but diversify and protect U.S. national security interests in doing so. This, John, of course, is part of an ongoing effort after in July, Secretary Yellen made a trip to Beijing for these similar kind of conversations. Other administration officials trying to normalize relations as well, all of it setting the stage for the big event next week.
Nobody say decouple. No one's allowed to say decouple. You got that? That seems to be the rule right now.
De-risk.
De-risk. De-risk. Diversify. Diversify. Okay? AMH, walk me through this. How does this set the stage for next week?
Well, Xi Jinping will be going to APEC. This is what all the tea leaves are telling us, even though the Chinese have yet to fully put that out there in black and white, Jonathan. But he's not only going to be meeting with Commander-in-Chief Joe Biden, but he'll be meeting with executives as well, the CEOs of America's biggest companies. We don't know the exact list, but there's going to be a dinner. There's a CEO summit alongside the APEC meeting, and you can see the likes of Satya Nadella of Microsoft there or Darren Woods of Exxon. So this is really important for Xi Jinping as much as it is for Joe Biden. Remember, China is dealing with a very fragile economic recovery. They want to woo investors, and they also want to make sure that they are sending a message that we are still open for business and really trying to tamp down some of these concerns when it comes to geopolitics. And this administration, Jonathan, does also need this meeting to go well. Can you imagine going to an election year when you have a conflict still in Europe with Russia's invasion of Ukraine, a conflict in the Middle East with Israel and the ongoing war with Hamas right now, backed by Iran, and then potentially a conflict in the Asia Pacific? They want to make sure that they tone this down and put a lid on this.
It's true. Looking forward to the coverage from both of you over the next week or so. Anne-Marie, thank you, alongside Kenny Lyons down in Washington. Let's get you some sector price action. Equity still just about positive with the sector price action. Here's Abby.
Well, it is a very small gain, but to your point, the best, longest, I should say, winning streak going back to 2004. Helping out today, communication services up 0.5%, really being helped out by Disney. Industrials up 0.5%. Energy, materials, tech, all higher. To the downside, though, we have some of those defensive sectors, healthcare, excuse me, and consumer staples in particular, although discretionary is down there. As for this rally, John, the best sector over the last 9 days, well, not surprising probably to anybody, it is technology, up nearly 10%. But we've had the S&P 500, again, the longest winning streak for such a long time. For the tech sector, not so much. It's a much more recent winning streak, but nonetheless, very impressive.
What a rally, what a run on the S&P 500. Abby, thank you. On the NASDAQ too, on the S&P 500, it could well be day 9 on the S&P. We've talked about this 2004 stat again and again. It's worth considering. Over the last 9 days, we're talking about a gain of something like 6.5%. It's quite a run. Up next on the program, your trading diary.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
A stress potentially 9 days of gains on the S&P. Let's get to the trading diary. Your day ahead looks like this. The Treasury selling $24 billion of 30-year bonds. Secretary Yellen meeting with her Chinese counterpart a little bit later this afternoon. Biden speaking later in the hour alongside UAW President Sean Fain. Chair Powell set to speak this afternoon as well at 2 p.m. Eastern Time in Washington. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we're going to kick this day off with a little roundtable talking technology. Mandeep Singh, Anurag Randa, they are senior tech analysts at Bloomberg Intelligence. They'll break it down for us. David Bahnsen, founder and chief investment officer at the Bahnsen Group, will talk markets. And then streaming wars. We have, I think, one of the absolute best media analysts on Wall Street, Michael Nathanson, founding partner and senior research analyst at MoffettNathanson. He's coming on. We're going to talk about the strikes ending. We're going to talk about Disney earnings. We're going to talk about streaming. Can anybody make money in streaming other than our friends at Netflix? So we're going to talk all about that. But first, let's kick things off with Mr. John Tucker and our Bloomberg Business Flash.
All right, 8 of the 11 major industry groups in the S&P 500 higher right now. Industrials, communication services, information technology, that is in the lead. But not much of an advance right now. After 8 days of gains, we're up only 2 points right now. A lot of it has to do with bond yields. They're higher. That's keeping a lid on the gains. The 2-year, 2 basis points higher, 4.95 there. The 10-year yield, that is up 6 basis points right now at 4.54. Markets are listening to central bankers. The Fed chief, Jay Powell, delivering a speech around 2 Wall Street time. Over at Evercore, ISI, Julian Emanuel says, you know what, the conditions have been in place for a boost to stocks.
If bond yields go down, stocks go up. And backing off of 5% was huge for the psychology. And now we've got this unexpected oil price plunge, which is even bigger.
Well, after its earnings results, Disney shares up over 6%. We'll break that down a little more coming up. Right now, up 5.75%. And then you have shares of Lyft. They are down 2.5%. The ride-hailing company delivering a lackluster revenue outlook for the holiday period. Once again, the S&P 500 up to 43.85 in the index. The Dow down 24 points. The NASDAQ 100 right now 22 points higher. That is up 0.1%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker studio. We are also streaming live on that YouTube thing, so head over to youtube.com and search Bloomberg Radio, Bloomberg Global News. Either one will get you there. Matt's attempting to log into his Bloomberg terminal.
I'm there. I'm there.
Okay, because I thought you didn't pay your bill this month. So, I mean, that could have been the problem.
Oh, man. Imagine not having a Bloomberg terminal.
Yeah, I know.
It would feel awful.
Yeah, that's going to be, I mean, it's just your crutch for everything we do. All right, let's talk a little tech here. So, at 12 o'clock today, I'm leaving you, Matt, early because I'm going to the airport.
At noon?
Duke, yes.
Is there a basketball game that you want to go to? Are we there yet?
There might be. There might be.
Is it
tomorrow,
basketball season?
Arizona, and Saturday football at Carolina. So there might be something there, maybe a board meeting too mixed in there. So I'm going to open up my apps to get to Newark Airport, my car apps, Uber, Lyft. I could care less. Whatever's cheaper.
You have zero brand loyalty.
Zero brand loyalty. But apparently the market does not. The market favors one way more than the other. So let's talk some technology here. We got Mandeep Singh. We got Anurag Rana. I guess they figured they'd come into work today. We appreciate that. They are senior analysts covering all things technology for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker studio. All right. Uber, Lyft, is it even a game anymore, or is it just Uber's market, man?
Is it even as bad as, I mean, are they as close as Coke and Pepsi or Pampers and Huggies? It's, it's far off, right?
It's far off, and right now the scale player is winning. They showed in the print the revenue top line is growing 30%. In Lyft's case, it's 10%, even though it's 4 times smaller. So clearly, as we have seen time and again with marketplaces, scale matters, and the company with the network effects and the most supply wins. And that's what we are seeing. And in the case of Lyft, I mean, they keep talking about cost cutting. For a company of Lyft's size to focus on cost cutting is just not going to pan out in terms of driving investor interest.
I don't get it. I'm going to open up my app, and whatever one's cheaper, I'm taking.
But here's the thing, Paul. Why you have to open up both apps? It's
okay.
like it takes your time, and your time is valuable, buddy.
Very.
You're going down to Duke for a board meeting,
exactly.
Right? So I mean, why bother?
It could be like when I go to Newark today, it could be 120. The other one could be 80. That's material to me.
That is a material
difference. What about
the
ETAs? So if one
it's
makes
the same driver sitting on 58th Street in the same car.
And that's where I think you're seeing a difference now. Uber's supply and ETA has just improved so much that Lyft just can't match. And when you expand that to all the zip codes and the different location that Uber operates in, you get that consistent experience. Even though the car experience may be different every time you take a ride, but in terms of ETAs, they are.
So what happens to
Can
Lyft?
I tell you my problem? The car experience is bad every time.
Well, you're driving in with the Dodge
How can I get a ride-sharing service that has somebody in a new car with suspension that isn't already shot? It's constantly like a 10-year-old Mercedes GLE that bottoms out over every single speed bump. Like, why is that? Even if I choose black, even if I choose VIP, and I know this is not the biggest problem in the world, but is there a way to get a decent ride?
Well, there are more nuanced and niche services, car services that you can take for that kind of experience. But the scale at which Uber is operating, 8 billion rides a year, I mean, this is huge.
I know, but I remember when they used to be high-quality vehicles, and they no longer are.
I compare it to the yellow cabs. All right, Anurag, let's go to you. Tech spending, it is not negative. It is just the growth rate is slower than you guys have been used to for the last 25 years. What is it, the rate of tech spending these today, and where do you think it's going to be over the next several years? Because that supports all of the tech stack.
So fair point. I mean, it has gone about 2 to 3 times GDP for the last several years. This is probably the first year we saw some pullback in discretionary IT spending, and we are seeing some shoots of, I would say, healthy growth or stabilization that AWS and Microsoft has cited. So we are expecting, unless geopolitical issues really get bad over the next 2-3 months, that when we get the IT budgets coming out in Jan, Feb, March, we should expect a rebound from this year. And that's good news for a lot of people that are investing in cloud-based infrastructure, AI tools, older technologies, PC and hardware upgrades, maybe not so much, shifting within the tech budgets, but we are optimistic that we'll see a rebound next year.
All right, so AI. We have Dan Ives from Wedbush Securities comes in here, the mega bull out there on technology. He says most, if not all, of the AI tech spending is incremental. What do you think about that?
I see there is some incremental out of it, but you cannot expect JP Morgan's IT budget to go up 15-20%. If it grows, let's say 5 to 6% a year, it may grow 1 point or 2 points. But what's going to happen is within that large budget, let's say it's $1 billion, you're going to have a big amount going towards AI, but it would be at the expense of something else. They may go out and say, well, we're not going to refresh our PCs for another year or our servers. There are other ways to cut that down. You just can't take a legacy company, the likes of Coca-Cola or Citibank, and just expect them to double their IT budgets.
All right, so where are we going to get growth? Are we getting still a lot of spending? Is the IRA going to start spending money into the infrastructure that you follow?
See, I think that's that's what I'm saying. I'm optimistic that we're going to see a rebound in cloud growth rates for Amazon, for Microsoft, for Google, and some of the other vendors. That's an area where we see there could be a lift. The application software guys, we are still seeing a lot more cutback in that area. Small, medium businesses are struggling. So we are not sure how that pans out, but I'm really getting optimistic about the infrastructure side.
I'm surprised as you are, Paul, because I thought with AI, when we all start using Grok, which is Elon Musk's version of ChatGPT, then these data centers are going to have to be adding servers, adding capacity, using more energy. That's got to get built up.
So, Matt, that's happening. They are building capacity. But what's also happening on the other side, all these large enterprises are cutting back on their cloud spend because that's an easy way for them to save money. It's not so much that they don't want to do it. It's just an avenue for them to scale back their IT spend or operating expenses.
All right. Let's talk about digital advertising, Mandeep. We just had a bunch of the traditional media companies report their earnings, and all, including the Walt Disney Company last night, all citing really, really challenging advertising environment for their cable TV networks, the broadcast networks, all that kind of stuff. What are you hearing from the Facebooks, the Googles, the Amazons of the world in terms of the digital spend?
I mean, surprisingly, they did much better this quarter, partly because of easier comps, but also you're finding more and more that digital ad spend still has a higher ROI compared to brand ad spend, which we all know, yes, it helps with your brand building, but there is no kind of traffic or, like conversion that you see right off the bat.
What is brand ad spend?
Well, brand is just showing an ad on TV about your brand. That's
Coca-Cola.
it. You're not driving a click that will help somebody make an e-commerce purchase.
I get it.
And that's where the social media platforms are so much more effective in targeting those ads. And in the case of Meta, they grew 20%. They guided for another high teens growth next quarter. So clearly, Pinterest had a great quarter. Google Search had a great quarter. And brand ad spend is shifting towards digital platforms because at the end of the day, if you're consuming your TV through YouTube or any of these digital channels, then they can still target those ads better than the linear TV. And that's why you're seeing so much pressure on the linear TV.
By the way, my biggest problem with Pinterest is always that I haven't been able to consume through it. Because I'll see something on an image search and I'll click deeper into it and find that it's from, no, I'm not on Pinterest, but if I'm looking for
with Amazon now. So
a specific,
that's the gap they're trying to fix. They partnered with Amazon.
Because if I'm looking, so I'll do research into figuring out, which make of A2 bomber jacket, a certain pilot was wearing, and I'll find the image on Pinterest, and then, but there's nothing because it was just some girl in the Midwest put it up there for her wedding planning purposes. Like it doesn't help me at all.
It's just a pin. And so now that pin is clickable and it takes you to the Amazon website and you can complete that shopping experience. Now, Amazon is the one who is getting all the traffic, but clearly Pinterest is getting paid in the process because they're helping drive that experience.
Anurag, what's the Apple call these days after their earnings? I mean, what's the typical investor, if he or she's going to buy an incremental share of Apple today, what are they buying, do they think?
I think they're buying more the macro, interest rate move rather than anything else. Because when you look at the fundamentals of Apple, they are not as good as they were, let's say, a year ago or so. I mean, you're not looking at a rebound now in China spending. The guidance were very bleak. So we're not so even sure how the year pans up because the holiday season's not good. They don't give good guidance for second quarter. You're not going to see any growth next year, or let's say 2 to 3% growth. And that's not a good for a company the size of Apple that has not shown any growth in 23 and is only going to show 3-4% growth in 24. So that's not, and the valuation keeps on going up, almost every day.
Did you guys see Shonali's story about her interview with Mark Spitznagel from Universa?
No.
He is very concerned about the economy. And I guess, that's kind of his job to be that concerned. He's a tail risk fund manager. So if you think disaster is coming, you invest with him. Okay. So he obviously talks up disaster. But he says, when the Fed has to cut, it's going to get really awful. That's a direct quote. He said, I think our rates are going back to zero. I mean, a lot of people think I'm nuts, but remember when a credit bubble pops, remember when just deflationary event, what a deflationary event that is. It's like taking a giant pile of cash and lighting it on fire. So it's just...
So Matt, let me just give you one simple thing. Yeah. If interest rate goes to zero, both Mandeep and my companies are going to do very well.
So this is exactly what I was going to ask.
I have no problem with that.
I mean, not if they go to zero out of the kindness of Jay Powell's heart, but if they go to zero because we are in serious trouble.
You know the Pinterest thing you're talking about?
Yeah.
It goes to Amazon?
Yeah.
Amazon's running a digital ad, a revenue of $50 billion right now. It was non-existent 3-4 years ago. So these big digital platforms, their ROI is so much better on almost everything that you do. Whether it's cloud, whether it's retail, whether it's advertising. So I'm not concerned, to be honest, about our coverages because you take the interest rates down, I'm happy with it.
Well, this gets to the heart of my question, which I haven't yet asked. If everything goes to hell in a handbasket and I still need to be in the market, but I want to get defensive, it doesn't seem intuitive that I would buy Apple, right? But on the other hand, I feel like they have so much cash and free cash flow that maybe it's a good place to hide.
There is a reason why Magnificent Seven has done well for the past 12 months.
Yeah.
Because that is perceived safe haven.
That's exactly
Everyone thinks they will continue to generate that cash, and that's why you're seeing that.
Is anyone in this room, we have 4 analysts, or 2 analysts and 2 broadcasters, anybody on Pinterest?
No.
I mean, I use it for my research, but I'm not a daily active user.
Research.
I mean, obviously not. Yeah, it's one of those networks that really surprises me that they continue to do so well.
Why do they do so well?
They have 450 million monthly active users. The daily active user count is low, but clearly there is a use case. And look, they advertise on Google search. So a lot of times when you're searching for something on Google, it takes you to Pinterest. Then in turn, Pinterest takes you to Amazon to complete that shopping experience. So there is that connection between the digital experience you have on the internet, and that's what these companies are doing.
I mean, what about in the control room? Like, is anybody, our producers or directors, is anybody on Pinterest? Elizabeth just got married. Yeah, okay, exactly.
Wedding planning only.
Wedding planning only.
Okay.
That's exactly what I think Pinterest is for. And
Snapchat,
only that.
Okay, I just put in the snap ticker into the Bloomberg terminal because I honestly didn't know if it was still public, still an entity. It is. It's got an $19 billion market cap. The stock's up 30% this year. What's the Snap call? I mean, I kind of forgot about the Snap.
Talking about monthly active users, Snap's monthly active users are 550 million. Their daily active users in the U.S. are over 100 million. Talk about platforms, like there are only 2 or 3 platforms like that, and they continue to get the traffic. So clearly, when you compare them to the large digital ad names, this is a cheap valuation, and because the rebound hasn't come, but they still have the traffic.
I don't know. It's a scam, this whole tech investing thing.
I just found out what a Visco girl was.
What's a Visco girl?
Today. I had no idea. Apparently, it's a thing that everybody knows about.
I never heard it before.
Visco, VSCO. It's like a photo editing app that teens use. And
is this the thing in the school in New Jersey?
I don't know.
Okay.
But apparently, it also operates as a social media platform. And back in the day when a girl was so happy that her boyfriend bought her Starbucks, that was considered basic.
Okay.
And this is like a step beyond. They have their own kind of aesthetic, and I've just gone into a Slate rabbit hole, like a Business Insider rabbit hole on Visco.
All right, Mandeep Singh, Anurag Rani, Senior Technology Analyst for Bloomberg Intelligence, breaking it all down for us. We can do hardware, software, the whole internet thing. We can do it all with these folks. We appreciate it.
Neil Grossman writes in and says, neither he nor Mindy have ever been directed to Pinterest.
Exactly. This is Bloomberg. Let's get some company news right now with Denise Pellegrini.
Hey there, yeah, we're watching Amazon because it is getting even deeper into the grocery business. We get more on what's happening from Bloomberg's Charlie Pellet.
Denise, Amazon is expanding grocery delivery even if you are not an Amazon Prime member. Non-Prime members will be charged about $5 to $14 for each delivery. Members now pay about $7 to $10 with free deliveries for large orders over $100. Amazon is also going to open more of those Amazon Fresh stores around the country as well. Charlie Pellet, Bloomberg Radio.
All right, thank you, Charlie. And Amazon shares, they are slightly lower right now. If you're thinking of not getting holiday gifts for someone this year because money's tight, you're apparently not alone. Wallet Hub says more than 1 in 3 Americans plan to skip some gift giving this year due to inflation. Well, one thing people are apparently not skipping is going to Disney theme parks. Disney out with a profit beat, and theme parks delivered a nice profit boost there. Losses in Disney's streaming division, meantime, those didn't look too bad either, thanks to Disney Plus subscribers. Still, Disney is looking to quiet activist shareholder Nelson Pelson, talking about massive spending cuts of another $2 billion. Disney shares, they're up by at least 6% right now in trading. And we're hearing the Federal Reserve is scrutinizing whether Morgan Stanley's wealth management business is doing enough to prevent potential money laundering, especially with overseas clients, wealthy overseas clients outside the U.S. Representatives for the Fed and for Morgan Stanley, though, had no comment on that. And those are some of the company stories we're following this hour. I'm Denise Pellegrini.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. I'm going to say yields right now, keeping a lid on risk assets. The 10-year, the benchmark up 7 basis points. We're at 4.55. The 2-year right now, 2 basis points higher. That's at 4.96. So after 8 straight days of gains, the S&P 500 lower right now, down just 7 points. Fed Chair Jerome Powell, he's going to speak at 2 p.m. Wall Street time. Investors getting ready for that, looking for any clues about monetary policy. You have 4 of the 11 major industry groups in the S&P 500 higher right now, and energy is the best performing group. Oil prices rebounding modestly from the recent losses. And then, of course, on the earnings front, you had Disney beating earnings forecasts late Wednesday, also raising the cost restructuring targets. Disney shares up 6.7%. And ARM, the chip designer, issued a disappointing sales forecast. The company pressured by weak smartphone market, also some uncertainties that they laid out. ARM shares right now 6% lower. Overall, the S&P 500 down 6 right now, down 0.1%, 43.76 on the index. The Dow Jones Industrial Average 94 points lower, and the Nasdaq 100 right now is 5 points lower. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube, so go check out youtube.com/ and go check out, search Bloomberg Radio. And Bloomberg is now in your dashboard. Even Tom Keene is on board with this. It's in your dashboard with Apple CarPlay and Android Auto. It gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, it's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your iPhone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, boom, and get started. It's all presented by our sponsor, Interactive Brokers, and it works really well on the new
so cool
BMW X3 Duke Blue.
Did you try it out?
Oh, yeah. It pops right up. It's like I don't have to do anything.
Yeah, it's awesome. The app, for the record, is white. Your car is Duke Blue.
Duke Blue, exactly.
Yes. But the app is the white Bloomberg app, and it comes up in the dash. And there's only so many apps you can use. You know, you can use Waze and Google Maps and stuff. But I guess we had to somehow negotiate with the Apple people.
It's Bloomberg. I mean, you know,
yeah, and so now you can just click on that. You don't even need to use Sirius anymore. So for me, it's like this move could save me potentially like $4.99 a month.
Right, in Sirius. And actually, we changed from channel 119 to channel 121 on Sirius.
True.
For those
I noticed that.
Paying attention there. All right, let's talk stocks. Let's talk stocks that pay dividends. And we do that with our David Bahnsen. He's the founder and chief investment officer at the Bahnsen Group. David, we've got, probably since the last time we talked, we had a nice move up in rates, kind of, you know. And I guess the question is, you know, dividend-paying stocks. How do you think about dividend-paying stocks in the context of, hey, I can sit in a 2-year treasury and get 4.96% here?
Yeah, it's a very good question. And I think that when the 2-year was at 0% for 15 years, people got a feel for what my answer is going to be. The 2-year is not going to stay at 4.96.
Right.
And if let's say you buy it and then in 2 years it's still at 4.96, it won't be, and it isn't growing. That's the issue with dividend growth, is the growth.
Okay.
Not only do you get something that is consistently going to be at the level at which you enter, it's going to grow year over year. With fixed income, they
well, hopefully, right? I mean, there have been companies like BP or Disney that have cut dividends.
Well, it'd be very, very important for a dividend growth manager to not allow dividend cuts to happen. So in 25 years, we've never had one, and I intend to go the rest of my career without one. But there are certainly companies that cut dividends, and we really don't recommend people
You don't get blindsided by something like BP? I mean,
yeah,
who saw that coming?
BP gave plenty of forecasts that what was happening. You had both President Obama and the former candidate John McCain recommending the same thing, that they ring-fence $20 billion of liability damage around it. There was no way they were going to do that and keep the dividend. So it gave people months of time to sell before the dividend was cut.
And that's why I need someone like him, because I didn't know.
I didn't know that.
A career maker for me was Citigroup in 2007. They came out and announced that they were continuing to pay the dividend. And at that point, it was up to about 7% yield. The stock was down. And then they borrowed $11 billion from the Kuwaitis and Saudi Arabian Sovereign Wealth Fund. And I said, I don't think people taking advance on their credit card to pay a dividend counts. It has to come from free cash flow. They have to have lower leverage. You have to have a good balance sheet. You have to have a business model that leads to sustainable free cash flow. That's why we have to be actively managing.
So how many names are in your portfolio?
Right now, 33 names.
33.
We've never had more than 35 in my whole career.
And again, and you're focusing exclusively on dividend growth, right?
Yes.
And how do you define, what's a good policy if I'm a CFO to plan my dividends? Is it a percentage of earnings? Is it a percentage of free cash flow? How is it?
That's interesting. Dividend payout ratios refer to a percentage of earnings that are paid out, but we like to look at the free cash flow and what percentage of that's being paid out. And I think most CFOs in America are used to annualizing a dividend, even if earnings or free cash flow may be somewhat lumpy throughout the year. I think it's a much better way to do it and affect their growth one time a year as opposed to kind of going up and down. We have, I think, 3 companies in the portfolio, and it's Blackstone, Apollo, and Blue Owl. They're asset managers that get carry, and carry is intrinsically lumpy, so they tend to pay it a little lumpier. But most just pay it in a systematic quarterly way.
So the ETF is TBG, the Bahnsen Group, pretty easy to remember. And so I click TBG, equity, DES into the Bloomberg, and then I can click the holdings tab. And I see Simon Properties as your top holding. Now, Paul and I don't know exactly what's in Simon Properties' portfolio, but Paul and I talk about commercial real estate with angst and fear every day.
Well, you're making a really bullish argument, by the way, for a contrarian investor, which is to say a good investor. But let me explain what's going on with Simon Property. It's 272 of the best malls in America. They have given the keys back for 4 of them. They were non-recourse. So they lost a little bit of equity, and the lenders had to go fight. Okay, right now they have the highest occupancy in the history of Simon Property at the highest per foot in the history of Simon Property, 96.9%. They've taken positions in some of the retailers that have failed. There are going to be more that fail. Now they've learned to monetize that. They took JCPenney for $500,000 a box. It was trading at $20 million a box. They're selling some to Amazon. They're reconverting some into condos and mixed use. It's this massive collection of real estate that can be repurposed, monetized into something more valuable. While they do that, we get an over 7% yield, entirely covered by net operating income, and the leverage is at about 47%. It was 65% before the financial crisis.
All right, number 2 is Verizon. That makes total sense to me, obviously, as a dividend play. Number 3, International Business Machine, Big Blue.
One of the great names people could buy, and this is an idea of a model we like a lot. You have old businesses that don't grow a lot, paying you a ton of free cash flow, with new businesses that are sort of not priced in, that represent a free call option. Will they become a real leader in artificial intelligence? I don't know. I think they will, but I do know this: it's not priced in the stock at all. The stock is entirely priced off a multiple of its book value of a kind of more old, stodgier businesses, but they have basically turned most of the business into software and consulting recurring revenue. So we love IBM. You get 5% dividend yield. The Red Hat acquisition was expensive, but they're monetizing it. So IBM's a great dividend grower for years to come.
All right, I'm heading down to Duke University this afternoon, and I may or may not bump into Tim Cook, CEO of Apple. If I were to get you 2 guys in a room talking dividends, what would you tell him?
Well, I would not tell him anything that others much smarter and more prestigious than me have not also told him, and they have failed, and so I'm sure I would fail. But what Apple's doing is shameful. And the inability to monetize that level of enterprise value, I think, is unacceptable. They will not do something with that $200 billion as profitable as returning it to shareholders. They bought Dr. Dre's headphone company for $3 billion. It wasn't worth $900 million soaking wet. But who cares? It's Apple. They make it in 5 minutes. My point is, in aggregate, you can set money on fire when you don't have an adequate shareholder return policy. They are a victim of their own success. This cannot be said as a criticism. They generate too much free cash flow to reinvest all of it. It has to be returned to shareholders. There ought to be a very large, juicy dividend coming back to shareholders. Now, here's the thing. They're going to do it. Steve Jobs wouldn't do it. Tim Cook did end up doing a small one. They grew so much, the yield is now 0.5 percentage point. I don't know if it's in a year or 10 years, but every one of these arrogant, cool tech companies finds out that at some point you have a higher return on equity returning this to shareholders. So all of the companies from the 90s that didn't do it, Cisco, Microsoft, Qualcomm, they all became great dividend growers later. Apple will as well. They're just not there yet.
You said you're going to talk to him.
I'm going to talk to him.
And you're going to tell him.
I'm going to say, I talked to this guy, David Bahnsen. He has a firm. It's his firm.
Yeah.
In Newport Beach, California. That's the beach.
Yeah.
Yet he spends 3 weeks a month here in New York. What are you doing, my man? It's your company. It's 3 weeks there, maybe a week here to talk to the eggheads in New York.
I really love to work, and I think you'll find the work ethic is a little more impressive in Manhattan than Newport Beach.
Are there other people that do like this intensive dividend strategy that you do?
There are other dividend growth managers. There are not. You mentioned this ETF that is active. Most ETFs that people own in the dividend growth space are passive, and I vehemently disagree with that approach. I think it's better than nothing. But we have built quite a business around active dividend growth, and it's what I built my career around. I believe in it very much.
Sold us.
The Bonson Group.
First time we walked
I'm trying
in
to
here.
get him on the ETF IQ program.
Do it. I think do a little remote out there in La La Land.
Yeah, we should definitely do
I know.
it from Newport Beach.
No, but instead we're going downtown to Lower Manhattan. David Bonson, CIO of the Bonson Group. We always appreciate getting his thoughts there, talking about some dividends and dividend growth strategy is probably the better way to think about it. With our news in New York City, here is Michael Barr.
Thank you very much, Paul and Matt. 5 Republican presidential candidates debated in Miami, Florida last night. On the stage for the 3rd Republican presidential primary debate on NBC, Ron DeSantis, Nikki Haley, Vivek Ramaswamy, Chris Christie, and Tim Scott. And at one point, Ramaswamy and Haley got into a prickly exchange over TikTok.
In the last debate, she made fun of me for actually joining TikTok while her own daughter was actually using the app for a long time. So you might want to take care of your family first.
Leave my
before
daughter
preaching
out
to
of your
anybody else,
voice.
adult daughter. The next generation of Americans are using it. And that's actually the point. You have her supporters propping her up. That's fine.